Good morning, guys. Welcome to the video. How are you? How are you? Fine. I'm good. So again, uh, once again, welcome to the video. I am your CA Veeraj, and we are going to discuss CA Intermediate Auditing and Ethics in a concise manner, but covering all the topics. So we will be doing this auditing marathon, almost for around 20 hours. 20 hours. Sir, what does this 20 hours consist of? See, this 20 hours consists of mainly discussion of the concepts. After we discuss the concepts, then we'll go to the question bank, which is covering till May 26 RTP also. And then lastly, again, as I told it in the law class, there will be some homework, which you have to do it by yourself. Sir, how do we discuss the concept? Do we discuss from the main material or is there any other material? No, we will discuss concepts mainly from our summary material. We have prepared a summary material for this revision session alone. The main material is around some 320 pages that we have concised that within 100 pages here. So the entire concept has been covered here within 100 pages. So if you do this summary notes, that will be you will be good to go for examination. So shall we begin? Yes. So initially, like whenever the RCB loses a first match, they tell that we will discuss chapter number 0 first, because that is important for examination point of view, as well as understanding the other concepts also. So the first thing which we have to discuss is what is audit. What is audit? Audit is audit. Huh? You people came for revision, not for regular class. Don't sit that dumb faced. Audit means it is an independent examination of financial information of any entity, whether or not profit oriented and irrespective of its size or legal form. When such an examination is conducted with a view to express an opinion thereon. See, in the initial maybe some 1 or 2 hour, it goes like the regular class only, because the basics are very important. Then we'll pick it up the speed. Sir, audit is an what? Independent examination. Sir, what is independent examination? Examination by an independent party. Sir, who is an independent party? The party who is not connected to the company. Independent party. The party who is not connected to the company. The party who is not an employee of the company. The party who is not a director, relative of KMP of any company. So that independent party has to do the independent examination of financial information. Why he is coming? For the purpose of checking financial information. Sir, what do you mean by financial information? Is it just the financial statements? It is financial statements including books of accounts, that is supporting documents for the financial statements. Even that includes even vouchers also. Any voucher, for example, sales voucher, purchase voucher, rent paid receipt, or maybe salary slips, or employee salary registers. Again, the books of accounts, the summarized version, sales book, purchase book, all those things. Again, if you much more concise that and put it in a summary form, that is financial statements. All the three are any things which is anything which is related to the financial statements of the company, books of accounts and vouchers are considered as financial information. So a outside party has to come to the company for the purpose of verification of these financial statements, books of accounts and vouchers. Of what? Of any entity. Sir, what do you mean by any entity? I am trying to tell that whether it is profit oriented or it is not profit oriented, I don't care. Wherever the money is involved, you should be accountable for it. Sir, whether they are accountable or not, we are going and checking in the company. When I say non-profit oriented, sir, they are working for the public only. Why this checking is required for that? See, when I say somebody is working for the society, they are getting some donations. When they are getting somebody else's money, definitely whether they are using it in the right manner or not, we should definitely know it. So that is why whether you are a profit oriented entity or non-profit oriented entity, it doesn't matter, you should definitely do uh, independent examination of all the financial information. Sir, okay, sir, I am okay to do that, but I'm a small company. I'm a small company, very, very small company. Am I also required to do that? Yes, I don't care. Irrespective of its size, whether you are a small company, medium company, mid-sized company, or large company, mid-cap, I don't care. Whether the moment you are an entity, you are dealing with financial information, definitely you are supposed to do get audited. And irrespective of its legal form, sir, what is legal form? Sir, I'm a company. Am I required to do the audit? Yes. Sir, I'm a LLP. Am I required to do the audit? Sir, I'm a partnership. I'm a proprietorship. I'm a Section 8 company. I'm a charitable institution. Am I required to? Yes. Yeah, it doesn't matter what is your legal form. You should compulsorily do the audit. When such an examination is conducted with a view to express an opinion thereon. Why we do the audit? We do the audit mainly for the purpose of giving an opinion, not for the purpose of what? Just time pass. When an outsider party comes to the company checking that whether insiders company or directors everybody is doing it in a correct manner or not, once they've been checked, the outsider party, we call it as auditor, we even call it as in a better manner practitioner, expresses an opinion that all the financial statements are showing true and fair view, or financial statements are not showing true and fair view. He has to give that opinion to the users of the financial statement. This is what audit is. What is audit? You should remember this definition very importantly. Audit is an independent examination of financial information of any entity, whether or not profit oriented, irrespective of size, legal form, or when such an examination is conducted with a view to express an opinion thereon. If you remember, if you see now, we discussed almost in some 4.5 minutes this definition. In the regular class, we go it for around 20 minutes with examples and all those things. Now, what are the objectives of the auditor? The auditor has only two objectives here. Auditor has how many objectives? Two objectives. The primary objective, as we know the meaning of audit, he should express an opinion. The objective of an auditor is to express opinion. Sir, when I say express an opinion, what type of opinion he should express? Auditor should express an opinion on the financial statements. If you look at the difference here, they told independent examination of financial information, but whenever they are telling about the expression of opinion, he is not giving opinion on financial information. He is just giving the opinion on the financial statements. Sir, how can you tell that verification is for all the state or this information, but giving opinion on the financial statements? If you just want to verify the financial statements, you need some base, whether it is correct or wrong. Again, we need one more page for books of accounts. That is why verification happens for everything. When everything is correct, then they express an opinion on the financial statements. Regarding what he will express, whenever the financial statements are prepared, whether those financial statements are free from MMS, whether the financial statements are free from material misstatements. Okay, as an as an auditor of a company, I came to a company, verified everything, and audit is completed. Once audit is completed, I should tell them, the company, yes, everything is correct, everything is not correct. What should I tell mainly in the report? Whether financial statements are free from material misstatements. For that, we should understand what is misstatements first. As the audit says, misstatement means something. The difference between ACPD of reported financial statements and ACPD of AFRF, applicable financial reporting framework. Sir, what is this reported financial statements? What is AFRF, applicable financial reporting framework? Whenever you prepare a financial statement, there are some frameworks. You should follow some accounting standard, you should follow some schedule 3, you should follow, if you are a special entity, banking regulation act, everything has to be followed. Whether what is required to be prepared as per applicable financial reporting framework, what is ACPD, we will discuss. It is required to be prepared as per AFRF, but how are you prepared? Reported financial statements, actual reported financial statements. If there is any difference between ACPD of required and ACPD of actual, the difference is called as misstatement. Sir, what is this ACPD? We call it as A is nothing but amount. This is amount. This is classification. This is presentation and disclosures. Any difference between amount which has to be actually written as per AFRF and actually how much you have written the financial statements. If there is any difference, or I should write 10,000, I wrote actually 8,000. There is a difference. That is called as misstatement. If there is any misstatement, sorry, difference between amounts, difference between classification, difference between presentation, or difference between disclosure. Sir, can you give an example? If you see here, as per, I used to continuously give this example, AS2, how do you value the inventory? Cost or NRV, whichever is lower. For example, in an entity, there is some cost of material and NRV of material. Consider cost is equal to 2 lakh, then NRV is equal to 1.5 lakh. At what price you should write it here, amount? 1.5 lakh, because as per AS2, they tell that cost or NRV, this inventory should be equal to 1.5 lakh. But actually you wrote it as 2 lakh. That means there is a difference between amounts. What you have actually required to mention 1.5, what you actually mentioned 2 lakhs, that is the difference. This is called as misstatement. Difference in amount required and actual. Again, if you look at AS13, what is AS13? Investments, accounting for investments. Whenever the investments are being matured within a period of 12 months, we call it as current investments. If not, it is long-term investments. Current and long-term investments. Now, there are some investments which are going to be matured, after 14 months. After 14 months, the amount is considered 20 lakh rupees. Where should I put it? Long-term investments, but actually I put it in current investments, 20 lakh rupees. But if you look at the balance sheet total, it is correct only, because asset is coming on the asset side. That is correct, I agree. Just by looking into the number, you can't tell that there is no misstatement. You should even check whether long-term investments are classified as current or current as classified as long-term. If there is any difference between classification of the items, here it has to come, but here actually it has come in the other statement item. That is why it is called as misstatement. Misstatement in classification. What is required and what is actually done. Required is long-term investment, but actually what you done is current investment. Then presentation and disclosure. For that, I'll continuously give an example of A17. A17. What is A17? Segment reporting. What is segment reporting? Whenever your the 10% threshold, you remember, 10% of turnover, 10% of assets, or 10% of profits is exceeding in absolute number, you should report it as a reportable segment in this thing. Now, there are some one asset which is being met 10% criteria. Then whenever you write notes to accounts, you should present and disclose this segment A, segment B, and segment C, out of which this is a reportable segment, these two are non-reportable segment. You should present it in this way. But actually, even though this is met, you just told it as A, B, C are the segments. You did not properly present it, or you did not properly disclose that. Whenever there is any difference between amount which is to be mentioned, which is to be entered, and what is actually entered, classification of assets or liability or anything. For example, you issued some 100 shares of 10 rupees each for 20 rupees. Face value is 10 rupees, but you issued 20 rupees. Now, 100 into 10 is 1000 is equity capital, remaining 1000 is security premium. Then you should classify it correctly. But anyway, you received because of the shares, you directly went and put it in equity share capital. That is totally wrong. You did not classify properly. So, any difference between amount, classification, presentation, or disclosure of reported financial statements and amount, presentation, classification, presentation, disclosure of applicable financial reporting framework. If this is called as misstatements. Sir, I agree. What were we discussing? We were discussing about objectives of the auditor. What are the objectives of the auditor? Auditor has to give an opinion on the financial statements regarding whether the financial statements are free from material misstatements. Now we understood what is misstatement. Now what is material? Sir, I should write rent expenses as 20 crore and 1 rupee. The actual rent expense is 20 crore 10 rupees. But instead of that, I wrote it as 20 crore rupees only. Now, is there any difference between amount? Yes, 20 crores and 10 rupees and 20 crores is totally different. There is a difference. But is that 10 rupee adding up to any materiality for you? No. Then those nonsense or this immaterial things, you just ignore it. You just as an auditor, because you are having very limited time with respect to those things, because anyway we are going to discuss that inherent limitations and a future concept, because we have a or this limitation on time and money, even the fees being paid, you should always try to focus on only material items in an audit. You should not never focus on the immaterial items. So you should tell in the opinion that all the financial statements are free from material misstatement. Free from material, free from means what? That is not caused by any biasness, that is not caused by any what is this, wrong classification, wrong presentation and all those things. First reporting, then and auditor also has to report in the opinion telling that whether they are prepared as per AFRF or not. Sir, you told AFRF here. What is AFRF? Applicable Financial Reporting Framework. Whenever you see a financial statement, that financial statement has to be AFRF. When I say AFRF, if you see, the word says that AFRF, Applicable Financial Reporting Framework. First of all, you should understand what is Financial Reporting Framework. When I say financial reporting framework, if you are a company, there is something called as Schedule 3. That you have to prepare your balance sheet, P&L, everything as per that Schedule 3 only. But if you are not a company, or if you are a company but governed by some special acts, for example banking company, for example insurance company, for example electricity company, then the financial reporting framework applicable for you is not Schedule 3 but as per their respective act. Banking Regulation Act gives in some other manner. Their Banking Regulation Act, you have to go and prepare it. Whether when I am expressing my opinion, I should check the financial statements, everything. Those financial statements are correctly prepared as per those respective acts or not. Applicable Financial Reporting Framework correctly prepared or not. Sir, I am a company, I will follow Schedule 3. It doesn't matter whether I am a bank or insurance, then you don't express an opinion. Even if you express an opinion, don't what is this? Tell that it is, don't express an unqualified opinion. Try to modify the opinion. This is what we call it as applicable financial reporting framework. For banking company, it may be different. For normal company, it may be different. For insurance company, for electricity company, etc., etc. This is what it happens. Whenever it is there, every auditor has to express an opinion whether the financial statements are free from MMS, material misstatement, and it is and, not or. And this is and. Financial statements are prepared as per free from MMS and they are prepared as per AFRF. AFRF means whatever the reporting framework applicable for you, just follow that reporting framework. No need to be always following Schedule 3 of the Companies Act. This is what the objectives of the auditor. Understood? So then comes the auditor, not so important definition. So auditor means any person or persons conducting the audit, usually the engagement partner as well as the other members of the engagement team or the firm. For that, if you remember in yesterday's discussion, we used to discuss that appointment of an auditor in the corporate law subject. Section 139 tells that section 139, not 139, 141. Who is eligible to be appointed as an auditor? Any individual or any firm of auditors are eligible to be appointed as an auditor. Now, when firm is being appointed, who is auditor? Firm is an auditor. Firm is, you are signing the audit report in the name of firm, but it is signed by one partner, I agree, but in the name of firm only. But if you are an individual auditor, you will be signing on your own name in the name of your signing in behalf of you only. So, auditor means any party who is part of the audit team, maybe engagement team, maybe the firm, maybe an individual practitioner. They simply tell that engagement team means the engagement partner. Engagement partner is a party who signs it, the audit report. Then again, audit manager, paid assistant, senior article assistant, junior article assistant, or any other designation. But this engagement team does not include few people. Like any people who are taken for the purpose of, for example, I am an engagement partner. Doctor told me to drink juice for every 2 hours. Because when I am in the work, I forgot to drink the juice. Because of which I kept an assistant in an engagement team. He is never part of engagement team. He never do any work. His work is to do what? Every 2 hours he should bring in juice for me. Just because he is with me, you can't consider him as an engagement team. Engagement team is something which is actually participating in the conduct of an audit. So that is engagement team. Then comes books of accounts. Sir, what is this books of accounts? Sir, why do we need the books of accounts? when we have a financial statement, sir, if you look at the financial statements, sales 25 lakh rupees. 25 lakh rupees, is it on the one day? Is it to a single person? No, it is a summarized version. In 1st April to 31st March, we done actually the 25 lakh rupees of sales. But if you want to know detailed details of what is this, day wise, persons wise, amount wise, credit or cash wise, anything, then you have to definitely go to books of accounts only. So books of accounts means any documents which are prepared by the company to support the financial statements. Financial statements are prepared on the basis of books of accounts only. When there is no books of accounts, then there is no financial statements also. So here they are telling books of accounts means defined under 213 of Companies Act, records maintained in respect of all sums of money received and expended by a company and matters in relation to which receipts and expenditure takes place. That means they are talking about P&L related. So sums of money received as well as money expended. That means P&L right side, P&L left side, debit and credit side. Then all sales and purchases of goods and services by the company. That means trading related. Whatever the entry you make with respect to trading, supporting the trading account, this is P&L account and this is trading account. That is called as books of accounts, are assets and liabilities and items of cost. This is balance sheet accounts related and this is cost account related. This is what we call it as books of account. Not so important, you just given. What is financial statements? Again, we will go by Companies Act definition. Financial statements means something consists of 5 elements: balance sheet, profit and loss account, cash flow statement, SOC, statement of change in equity, and notes to accounts. Balance sheet, P&L, cash flow statement, SOC, and notes to accounts. Then who are the users of financial statements? See, when the financial year is over, consider 2 days back, not 3 days back, 31st March, we prepare a financial statement. Why we prepare the financial statements? Just to time pass, huh? Because as a company we are using public's money, we are using some investors money, some banks money, some other money. We should be accountable. How much money we have, how much money is spent, how much profit, everything has to be reported for the public. When I say public, we call it as users of financial statements. Sir, what is users of financial statements? If somebody has invested, they want to know what is the status of their capital. Is it increased? Is it decreased? Is it the same? Are we going to get any return? Then comes mainly it is like users of financial statements are, they are given here, shareholder. For what? To analyze the performance, profitability and financial position, and whether to know that do we continue to invest in this company or not in this company, we can take the decision. With respect to management also it is there. Sir, why this management? How we are performing today? How can we improve it for tomorrow? For the analysis of that we need financial statements, yes. Then lenders and bankers, to know that how much profit they made, how much return they are getting, and suppliers, whether their future is secured or not, to check that what is the status of company. Again customers, again government. Why government? For the purpose of looking into the taxation matter, because income tax is paid on the profit. Whether profit is correctly calculated as per the Companies Act and accounting standards or not, that has to be checked. Research scholars and employees, etc., etc. Employees for job security. Now you told AFRF, applicable financial reporting framework. I told AFRF means something which is applicable to your entity is applicable financial reporting framework. Now what is what types of financial statements are applicable to your entity? For that we should understand. There are 2 types of financial statements. The financial statements are categorized into 2 types. One is general purpose financial statement. Second one is special purpose financial statement. Sir, what is the general purpose and special purpose financial statements? If you look at the balance sheet, P&L of any company which is available, for example, this is a balance sheet of ITC Limited. Here if you see here, PPE, capital, work in progress, investment, etc., they have given here. Now, whenever you are writing property, plant and equipment, how they might have written it as What is this crores? 22,000 crores. Because AS10, the accounting standard 10 tells, here it is AS not applicable, Ind AS is applicable. AS10 tells that whenever you are writing as in the end of balance sheet date, you should write it on a net basis. That means gross value in the beginning of the year minus depreciation or accumulated depreciation, anything is there, and you write it on the net basis. Now AS10 talks about this thing. That means not this company, any company, whenever they are writing property, plant and equipment, definitely they have to follow with accounting standard 10 only. When everybody is following the same thing and everybody knows that this is what it is being followed, then we call it as general purpose financial statements. Or in simple terms, technically we call it as general purpose financial statements are those financial statements which are prepared using general purpose framework. GPFW, general purpose framework. So what is general purpose framework? Any framework which is framed for the purpose of usage of general public. Not for a one person, not for an entity, not for just the government. For everybody you can use it. And for example, whenever you read accountancy from PUC, degree, graduation, again CA also, everywhere it is learned the same thing. When everything is general and everybody knows it, and if you prepare your financial statements as per those frameworks, we call it a general purpose financial statements. In simple terms, GPFS are those things which are prepared on GPFW. General purpose financial statements prepared on general purpose framework are called as general purpose financial statements. Now, special purpose financial statements. So, what is this special purpose financial statements? Those financial statements which are prepared using special purpose framework. So, what is special purpose framework? Any framework which is specified specially by an entity. For example, I went to as a bank as a company for the purpose of borrowing the loan. I am asking the company, a bank, sir, please give me 100 crore rupees of loan. See, look at my balance sheet, look at my P&L, give me 100 crore rupees of loan. But bank is telling, sir, everything is there, but everything you, as per accountancy, you go for accrual concept. But your company already proved that more than 50% of the customers are not repaying back only. Then what is the use of having the accrual concept and accrual based accounting? I don't trust these financial statements. I want this your financial statements to be on a cash basis. Every year when you make a sale, how much cash you receive, how much cash you spend. That's it I want. That means that is not as per everybody. Bank is specifically asking that you should prepare your financial statements based on some framework. That is called as special purpose framework, and that is called as special purpose financial statements. When these special purpose financial statements are prepared as per SPFW, that is not useful for all the public in general. Government also will not use it. What are the users of financial statements we have seen? No, for everybody it is not useful. It is useful for those people who are demanding that to be prepared. Bank will see that okay, they have a liquid cash of 10,000 crores, giving 1,000 crores loan is okay, I can give it. So for their purpose only it is there. That is not for a circulation in public. But general purpose financial statements can be circulated in public. You don't need to be like afraid of anything. It is available for the purpose of circulation. So coming back, general purpose financial statements and special purpose financial statements. If the financial statements are prepared in accordance with the GPFW, general purpose framework, they are called as GPFS. If the financial statements are prepared as per special purpose framework, is called as special purpose financial statements. That is mainly the requirement of a specific user. That is not for every user, but for a specific user. Government is asking, okay, whenever you are preparing financial statements for the taxation purpose. See, financial statements are prepared multiple times. For income tax, if you have learned income tax, there is something called as 35 AD. What is that 35 AD? Huh? No, not that. 35 idea. There are some 14 businesses which you can claim 100% deduction in the first year. Which section? Section 35. Section 35 only. That means, as per accountancy, what they tell is, you should charge your depreciation based on useful life of the machine. If it is 10 years useful, divided by 10, you charge in the P&L current year. But that means when you divide it by 10, depreciation is a lesser amount. 10% depreciation will charge. Depreciation is a debit side item. That means profit is more. You are charging less depreciation. Profit will be more. But think from income tax angle. They are allowing 100% depreciation. That means it is debited not by 10%. It is debited by 100%. Because of which your profit will come down. Now the financial statements which are prepared as per income tax, that is only for income tax department. You can't give it for some public. The public is always concerned about the Companies Act. Where a company prepares for Schedule 3. I don't care how much income tax you pay, how much income tax you don't pay. You go for some deferred tax, you go for some, what is it, set off, AMT, MAT, minimum alternate tax or alternate minimum tax. You do all those things. I don't care. That is called as specific financial statement, special users, not for general public usage. But when it comes to general purpose framework, na, how many general purpose frameworks are there? There are two types of general purpose framework. One framework is fair presentation framework. Fair presentation framework. Second framework is compliance framework. Sir, what is this fair presentation framework and what is this compliance framework? Whenever you are required to prepare a financial statements in accountancy, there is a rule, unwritten rule, or you can call it as one trend that is continuously being followed is, whenever you are required to present your financial statements and you feel if I follow these rules, financial statements may not be presented properly. Why? Because for example, I'll take depreciation part only. I thought I should charge depreciation on a SLM basis. The life is for 10 years. But if you look at the production of the machine, the production is like this thing. Sometimes it is very low, again it goes up, again it comes up. That means 10 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It is there where they tell that first year only 10,000 units are being produced, second year 30,000 units are being produced, third year 55,000 units are being produced. In that case, in AS10 also tells that you should charge a depreciation based on the future economic benefits that is expected to flow to the entity. How much you are expecting? 10, 20 and 55. Then you should charge the depreciation based on 10, 20 and 55 ratio only. If you charge an SLM based method, that is not right. Sir, why you are explaining this example? Because compliance framework tells that you don't deviate from anywhere. I don't care whether you get 10, 20 and 55, I don't care. You just go by SLM method. That is called as compliance framework. Then that financial statements are not fairly presenting or showcasing anything. Sometimes it is understating, sometimes it is overstating. That means you can't deviate from whatever it is given. But if you are allowed to deviate for the better presentation of the financial statements, then that framework which is being followed is called as fair presentation framework. As an auditor, if nothing is specified, 90% of the thing we consider that it is fair presentation framework financial statements only. Compliance framework financial statements are very rare. It is not available only. So, what is the main difference? You should, if you look at the MCQ point, it is being asked many times. This is also MCQ. So it refers to a framework where financial statements are prepared and presented, agreed, in accordance with their requirements of such framework without any deviation. That means what they tell, just follow it. You don't do any better presentation, not better. No, I don't care. Just follow what you feel, what is being told. The words true and fair will not be there. True and fair will not be there in the audit report or financial statements, in the financial statements in this type of framework. So fair presentation frameworks are, it refers to framework where financial statements are prepared and presented in accordance with requirements of such framework, that is compliance, as well as contains some disclosures beyond the requirements of such framework, or they may deviate from the requirements of framework so as to achieve the what? Fair presentation framework. Sir, ನಾನು ಇದನ್ನ SLM ಮಾಡಿದ್ರೆ ಸರಿ ಆಗಲ್ಲ, I should go for sum of units method. Yes, you can deviate and get it into a better presentation format. So in that case, the words true and fair will appear on the financial statements. So most of the general purpose financial statements are prepared as per fair presentation framework only, not as per compliance framework. Now comes, if you look at the definition, we told legal form, irrespective of legal form, that is proprietorship, partnership, LLPs, company, society, company, FPBOI, etc., etc. Now misstatement also we discussed. Difference between amount classification, presentation or disclosures of a reported financial statements item and the amount classification, presentation or disclosure that is required as per applicable financial reporting framework. This misstatement can come because of the error also, this misstatement can come because of the fraud also. Sir, instead of writing 20 crore rupees, by mistakenly I wrote 1 zero extra. That happens because we are humans, we tend to make the mistakes. That is because of the error. Unintentional mistakes, unintentional wrongdoings are called as mistakes. No sir, I wanted to make some 18 crore rupees profit. That is why I added 1 zero extra. That is called as fraud. intentional act done by any party or maybe management, maybe employee, maybe top level anybody for the purpose of what, getting some extra advantage of the using some company's assets or something else. When I say fraud can happen in two ways. Fraudulent financial statements are misstatements of asset or fraudulent asset. What is it? Misappropriation of assets. One is fraudulent financial reporting, second one is misappropriation of assets. That means generally this misappropriation of assets happens at a lower level category. That means you are an accountant, went to the company, you saw that one pencil box full is there. You thought you have a small kid, so you took one pencil and put it in your bag. Nobody is going to verify anything. One pencil. That is called as misappropriation of assets. So only pencil now, I don't care. Is it misappropriation? Is it correct? Yes, it is fraud. Intentionally you are doing that. What is fraudulent financial reporting? Fraudulent financial reporting is something where you try to understate or overstate the financial statements only. That means understatement of inventory, closing stock, overstatement of opening, something you are doing for the purpose of what? Achieving some predetermined goals. You want to achieve some extra profit, so you changed your financial statements items and you started disclosing it in the public. That is called as fraudulent financial reporting. So what is fraud? It is an intentional act by one or more individuals among the management, TCWG, employees or third parties involving the use of deception to obtain what? Unjust or illegal advantage. For the purpose of obtaining those things, it is being committed. It can be because of fraudulent financial reporting or it can be because of misappropriation of assets. This is important from examination angle, this misstatement and this fraud also. Error means it is an unintentional act, mistake in the financial statements such as clerical error, omission, commission, error of duplication, compensating errors, etc. There are two types of errors. Again, this can be asked as an MCQ. Self-revealing error and non-self-revealing errors. What is self-revealing errors? The moment you look into something, you automatically find out, or they only disclose themselves as it is some mistake is there. That is called as self-revealing errors. What is non-self-revealing errors? You should do some audit procedures to find out that there is an error or not. That is called as non-self-revealing errors. Not apparent. Not apparent means not visible. And require additional efforts to detect them by the auditor. This is about the fundamentals. See, whatever we discussed, it is not part of it is not a separate chapter, but it is part of every chapter wherever it is applicable. Whenever it comes, I'll just give the reference and I'll move forward with respect to examination. Now we will discuss or continue from chapter 1. If you look at our summary notes we have prepared, how it is being designed is, this is index where you can see that the essay number, essay name, everything. Along with the chapters, I kept all the essays in a separate manner and I kept all the other than essays part at the end. If you see here, it is on a serial number basis. Chapter 1 is NOS audit, I kept again 200, 210, 20, 30, 40, 15 are there, 60, 65, 99, 300, 15, 20, 30, 450, 500, 1, 5, 10, 20, 30, 14 are there, 50, 60, 70, 80, again 600, 10 and again 610, 700, 1, 5, 6, 10 and SQC 1. This is what entire standards are applicable for the syllabus. After that I have given professional ethics part. Then CARO 2020 we have given audit risk. Actually audit risk is part of chapter number 3. Chapter number 3 is consisting of multiple parts. One is essay 315, essay 330 part is there. That is separately given an essay. Then there is something called as audit risk. Audit risk is consisting of ROMM, risk of material misstatement and detection risk. Inherent risk, control risk and detection risk. That combination is given as audit risk. That part is separately given here. Then internal control. In the chapter 3 only internal control is separately there. After that there is something called as automated environment. I think automated environment is included in that only. Internal control. After that bank audit is given, different types of entities, and in the financial statements audit is being given. SA 220 is given here and SQC 1 is given at the end. So if you look at the chapter also, this is mostly like most of the consents are concised portion, but it is not compromising on any content which has been removed or something like that. Every content, if you follow this note, that is sufficient from examination point of view. If you see, it is being formatted in such a way that it is easy to read and remember based on a tabular format. After that, here only essay 200 is being starting. If you look at this is a summary notes, there is something called as key exam tips. It is like a summary to the summary. So whenever we are discussing, whenever you are reading, read the main material first, then read the summary material first, then after that key exam tips. So whenever you are, why did I give this key exam tips now? Whenever you are just getting into the examination, just have a look into all the chapters key exam tips. That might be tested for MCQs also, that may be tested for descriptive also. If you just like last half an hour, if you are getting into 1:30, start at 12:45 or 1 o'clock, then just have a look into, okay, it is all the 10 chapters, all the 11 chapters, and get into the examination. That will be better for you to retain the concepts and do that. So this is how it is there. After that, essay 210 is there. Essay 210 also I have given some summary kind of things. 220 is there for everything I have given. See, if I remove that, it is 127 pages. If I remove all those things, it is less than 100 pages only. That if I remove key exam tips. See, it is key exam tips is not extra things. Whatever it is given in the summary note, that summarized version of that single line, single word, it is being given here. 230 also. Every standard, every chapter we have given that. I think 1 or 2 chapters is missing, mainly financial statements, because I can't give any summary for that financial statements. I think I did not give for that. Check it. Yes, it is not there for financial statements. Even for a bank also, I think it is not there. Yes, it is there for only 15 points. Again, not bank. It is different entities. For banks also, there are some 10 points which are given here. So many, not many, 99% we have given that exam tips also. So, sir, how do we discuss? Do we discuss in the orderly format? Generally, no. Whatever the form is, like where can we connect the concepts and important from examination area, then we'll start and discuss from that part. Initially, we will discuss the chapter 1 along with essay 200, because that is basic for everything which we have to discuss. After that, we will see which can be connected to what standard, and we can continue to discuss. Shall we continue? If some concepts I feel it is very simple, or you don't need any of my help, definitely I'll give it as homework. You should be reading that and coming for the next revision class. So first one is some basics part only, this chapter 1. Did we discuss the chapter wise analysis of weightage? No, right? Okay. Discuss that. Let me see whether I have that in this notes or not. See, this is a section-wise weightage which we have discussed in the class. Still, I am discussing. So, from the first, it is given by ICAI, entirely ICAI only, based on the question papers and all. So, chapter 1 is around 4 to 6 marks. How many marks question paper is there? 100. That means some 5 marks question around they can come here. Some strategy planning and program, some around 10 percentage. Again, risk assessment, internal control, automated environment, and internal control and audit risk. Everything put together, it is 8 to 12%. Audit evidence and documentation. That means 500 series, 500, 501, 505, 10, 20, multiple up to 550, and 230. Consisting of that, it is around 18% maximum. Financial statements is 12 to 20%. Then completion and review, that is 560, 70, 80. Then again 600, 260, that part 8 to 12%. 700 series entirely 8 to 12%. Entities is 18 up to 18%, including the bank audit. And ethics as around 10%. Ethics is very simple concept, less content, and it is having a weightage. If you look at the chapter wise, it is mainly on our question bank part. In the first chapter we have 13 questions. It is the marks you can expect is 4 to 6 marks. Audit second chapter 8 to 12 marks, again based on the percentage only I put it into the numbers multiplied and put it here. So based on few past examination of ICA only, we prepared this chapter wise weightage analysis. So if you look at here, the highest thing we should with less efforts we should focus on is, there are many chapters which are 8 to 12, 8 to 12, again 8 to 12, 8 to 12 are there. We should put it in a priority. Again, evidence is also there, financial statements. Sir, how are we going to discuss? Mainly, I feel this order what I should discuss. We will discuss first chapter, essay 200, maybe essay 210 also. After this bundle, we'll go to ethics part. We will complete that ethics because that is important and lesser content is there. Once we complete the ethics part, then we'll come for reporting part, 700 series entirely. Along with 700 series, we will add some 260, 570, all those things wherever reporting related are there, we will discuss that. Then we will try coming from maybe wherever it is required. Maybe we'll pause that things, then we'll go for some other than essay based, maybe. If not, we'll complete first all the essays, then we can go for other than essay chapters. So how it works out, we will see depending on your response and the class things. So starting chapter 1, NOS audit, nature, objective and scope of audit. First of all, we should understand what is engagement. What is engagement? Engagement is something where groom to be, bride to be come in front and they exchange the rings. That is called as engagement. Yes, that is also engagement, but I am not talking about that engagement. I am talking about audit engagement. Engagement means here in which it is something in which the auditor as well as client comes together and agrees for some work. What is that work? Auditing of the financial statements. Why? Because he has to give the audit report on the financial statements after completing all the audit. So engagement means it is an arrangement to do something in the context of auditing. It means a formal agreement between the auditor and the client under which auditor agrees to provide auditing services, and the moment they agree according to this is called as an engagement letter. Sir, what is engagement letter? Don't worry, we will discuss in 210 engagement letter. Then is audit mandatory or voluntary? For some entities it is mandatory if it is given by the act. For some entities it is voluntary. And who appoints an auditor? Generally owners appoints an auditor. Except first auditor, owners appoints an auditor. Who are the owners of company? Shareholders. Shareholders will appoint the auditor subsequently. Government company, who is the majority holder? C&A, government, central government or state government, because of its C&AG will appoint. Again, when it comes to partnership, partners will appoint. So appointing authority is generally in case of companies, shareholders in AGM, government companies C&AG, and reporting is also done to those who have appointed the auditor. That means whenever you give the report, there is a format for reporting. One or this addressee, title, addressee, opinion, basis of opinion. The addressee has to be the appointing authority. If C&AG appointed, you give it to C&AG or Government of India. If shareholders appointed, give it to the members of shareholders, etc. Now, what is assurance engagement? Any audit type of engagement which is agreed between client and auditor for the purpose of expressing an assurance that everything is free from MMS or AFRF is being followed, everything is not. That is what we are trying to tell that. So giving an assurance, that means my opinion is being considered there. Sir, are there anything which are other than assurance engagement tests? Income tax return filing, GST return filing. I don't give my opinion. Whatever the data client gives, I just file it and complete it. So assurance engagement means it is an engagement in which practitioner expresses. The word used is practitioner, not the chartered accountant, not the auditor. Expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of the subject matter against the criteria. Intended users are those people, employees, shareholders, government, etc. etc. So designed to enhance what? The degree of confidence. See, whenever you prepare something as a company and give it to the shareholders, they may not trust more compared to when you prepare something and it is audited by some independent party who is governed by some professional ethics or some regulatory authorities. Then people just tend to trust more. That is why that will enhance the confidence of the users of the financial statements other than responsible party. Sir, who is responsible party? Who is responsible to get himself as audited? Company is a responsible party. So company need not trust or company trust doesn't matter. The trust you should increase the confidence is regarding the users of the financial statements. We call it as a tri-party relationship or three-party relationship, where there are three parties. One is a practitioner, second one is a responsible party, third one is an intended user. So who is the practitioner? He is a CA. Responsible party is a company or maybe any entity, partnership firm, LLP, etc. society. Intended users are mainly the shareholders or maybe others also. What is appropriate subject matter? Why do you come? What do you want to audit in the company? Why you come here? You want to audit whether one director is having affair with one more director, or is that what you want to find out? No, you want to find out what? Mainly with respect to financial information that has to be examined by the practitioner. Only financial information you are concerned about. What is suitable criteria? You should always try to use the benchmarks, evaluate the subject matter, follow the standards on auditing, guidance given by the institutes, laws, Companies Act, rules, regulations, whichever is made. Sufficient and appropriate audit evidence. Whenever you decide to go to an audit assurance type of engagement to give the opinion, first of all, you should convince yourself that everything is free from material misstatement. Then only you can tell somebody that everything is free from MMS. Unless until you convince yourself. Sir, how do I convince myself? By obtaining SAAE, sufficient and appropriate audit evidence. How much ever I felt sufficient, so much evidence is available. Whatever the evidence I felt appropriate expressing an opinion, that appropriate evidence is also available here. So sufficient is always related to the quantity. Sir, I am eating roti. One roti I had, two roti, three roti. Is sir sufficient, sir? I am okay. That means quantity part is done. What is appropriate? I wanted to eat roti, but they gave chapati. That is not appropriate. That means whatever I wanted, I got that in the respect to quantity, quality. That is what we call it as appropriateness. Appropriateness is related always to the quality. This is an MCQ point. They asked sufficient relates to dash and appropriate relates to dash. MCQ, they give two things. Then after you complete the audit, you should give what? One assurance report that is in a written format, written assurance format. So written assurance report in appropriate form of an assurance engagement has to be given that everything is free from MMS or everything is not free from MMS. Something you give it to the company and users of the financial statement that you have audited everything. Then types of assurance engagement, there are mainly one is non-assurance engagement is there, that is not being covered here. One is audit, review, and actually there are two things, two other things else. We call it as SAs, four things: SA, SAE, SRS, and SRE. SAE is there. SA, SAE, SRS, and SRE. Review services, related services, assurance engagement, and standards on auditing. There are four types of assurance engagement. What is assurance? Mainly in case of audit, we try to give a reasonable type of assurance. Sir, what is this reasonable type of assurance? Where assurance is high level of assurance, but not 100%. An assurance is an high level of assurance, but not an 100% assurance. Because of what? We will discuss in some time. Inherent limitations of audit engagement. And whenever you are doing an audit of financial statements, generally you are doing audit of financial statements of historical financial information. Because something which is already completed, then only you can audit it. If it is not completed, you are telling that in 2030 we are going to do so and so sales. Can you do the audit? No, it is just in your mind. How can you put it in a paper? That is not possible. What is the actuality? In case of review related services, we don't express the reasonable assurance, we express the limited assurance engagement. They may ask this also as an MCQ. In case of audit, what assurance is given? Reasonable assurance. In case of review, what assurance is given? Limited assurance. Related to financial information prepared on the basis of historical financial information only. Generally, review, why it is limited assurance? Because it is not for full financial statements. Maybe they might ask you to do only P&L verification, only balance sheet verification, or first 3 months or first 6 months. Part of the financial statements are being verified. That is why you are not giving reasonable assurance also. Other assurances are prospective financial information like forecast and all, if you prepare some budgets, and assurance regarding operations of controls, etc. Why standards are required? You should read it. I am not discussing that. Why standards are required? For example, SA 200 to SA 800 is there. Why that is required? Because even you are an auditor, when I am an auditor, when she is an auditor, when he is an auditor, everybody has to follow the same thing so that the uniformity is maintained throughout the country. And there are some advantages, the multiple things are there. That is why standards are required. Then this is an examination question for 4 marks. Difference between reasonable assurance and limited assurance. Reasonable assurance is a high level of assurance. Limited assurance is a lower level of assurance. We call it as the limited assurance. Limited or lower level assurance. Procedures performed. It is an elaborate and extensive procedures to obtain SAA. Here, only fewer procedures are compared to the reasonable assurance are being performed. The drawn reasonable conclusions on the basis of sufficient and appropriate audit evidence. But here obtain sufficient and appropriate audit evidence to draw limited conclusions. Limited conclusion ಎಷ್ಟು ಬೇಕಲ್ಲ ಅಷ್ಟೇ opinion ಇದು ಮಾಡ್ರಿ. Examples is audit engagement, it is review engagement. You should write 4 points for 4 marks. 4 points for 4 marks. Then this is maybe an question, qualities of auditor, how an auditor should be there. You can go through our material. I'll also give this as homework. You don't need my help. You should be tact, caution, be careful, like firmness, calm, good temper, integrity, honesty should be there. Discretion means he should decide on his own. Industry means he should have the knowledge of all the industry which he is doing the audit. If you are a bank auditor, then you should know Banking Regulation Act, RBI Act, everything. Then judgment, you should have a right or this mind in a such a way that you are getting a judgment. You can make judgment. Okay, this is right, this is wrong. You are not dependent on somebody to always make a judgment. Patience, clear-headedness. Clear-headedness means purpose. What I want, yes, I should give the report. This is what clear-headedness. This is given here, SA, SRE, SAE and SRS. You can go through that. This is what nature, objective and scope of audit. Now we will begin with, see, SA 200 and invoice audit is combined anywhere. So now overall objectives of independent auditor we are not discussing because we discussed in a fundamental chapter. Overall objectives of independent auditor is to express an opinion whether the financial statements are free from material misstatement and financial statements are prepared as per applicable financial reporting framework. The same thing is there here. That is obtain reasonable assurance about whether financial statements are as a whole are free from MMS, whether due to fraud or error, so that you can express your opinion regarding whether financial statements are prepared in all material aspects in accordance with AFRM. Okay, this is also a 4 marks question. Overview of scope of audit. What is overview of scope of audit? Whenever somebody appoints you as an auditor of a company or any other entity, I'm always taking the word company. Company means it is all the legal forms is covered. I'm just taking a representation as company now. So whenever you are being appointed as an auditor of the company, director tells that, sir, while you are coming na, on the way only my daughter's school is there. Please bring her to the office. I'll pick her to my home. Are you required to do that? No, not required. What is covered in the scope of audit? What is covered in this area of audit? What is not outside the area of audit? That is what we are going to discuss. Audit is covered. Audit has covered all the aspects of entity relevant to the financial statements being audited. Whenever you do any, see, as an auditor, you are mainly concerned with financial statements. That is why you are required to express an opinion on the financial statements only. So all the aspects with respect to entity relevant to the financial statements of being audited, you should cover those things. Maybe books of accounts, maybe vouchers, maybe bills, maybe rent expenses, maybe salary slips, etc., etc. Anything related to financial statements you should cover in your audit scope. You should always even cover reliability and sufficiency of financial information, proper disclosures of financial information that is being correctly done or not, that also has to be verified by you only, and expression of an opinion on the financial statement. These are the mainly four things. One is all aspects regarding the entity relevant to the financial statements, reliability and sufficiency of financial information, proper disclosure of financial information, and expression of an opinion on the financial statements. What it will not include, audit does not include responsibility of preparation and presentation of financial statements. As an auditor, you are going for verification of financial statements, not preparation. Somebody has to do the preparation, you should do the audit. That is why maker and checker concept has to be separate. Again, any duty which is outside the scope of competence of an auditor. For example, I went to the audit of a company, but they are asking, sir, please give us income tax advice. No, it is outside your competence. You don't give it only. Expertise in authentication of documents. Whenever I am going for audit, I want to verify physically, okay, 1 bench, 2 bench, 3 bench. Whether I don't know, these benches are actually the property of the company or they just bought it for rent for some 10 days. We don't know. They are giving some documents. I am not an expert to verify whether the document is a original or fake document. So I am not an expert in authentication of document. Authentication means verification and investigation. When I'm asking an explanation to an employee and the employee is not giving an explanation, can I directly beat him on his slap him? No, I'm not an investigator. I'm not a CBI officer. I'm just the party who is there to, just like a postman, take the information from the company and pass it on to the users of the financial statement. So I should not be involved with respect to investigation. So these are the scope of audit. Then this is the 5 marks question. Inherent limitations of an audit. What is inherent limitations of an audit? Whenever the audit is being conducted, auditor cannot give absolute assurance. Why? Because of these reasons. What is absolute assurance? He can't tell that all the 100% financial statements are correct. Why he can't tell it? Because auditor is not expected. Nobody is expecting the auditor. Even auditor cannot do that also. What? Reduce the audit risk to 0 because there are inherent limitations of an audit. What he cannot do? Auditor is not expected, as well as he cannot do reduce the audit risk to 0. What is audit risk? We should discuss. We have a separate chapter. We will discuss there. Audit risk to 0 because there are some inherent limitations of audit. Sir, what are those inherent limitations? These are 5 limitations are there. Nature of financial reporting, nature of audit procedure, it is not an investigation, timeliness and relevance, and future events. Sir, what is this nature of it is not an investigation? We just now discussed it is outside the scope of authority of an auditor. That is why we can't do the investigation and we can't express an opinion stating that everything is true and fair. So because of the nature of financial reporting, what is nature of financial reporting? In many cases, what happens? Company makes numerous amounts of judgments while they are looking into the life of the asset, while they are creating the provision for gratuity, PF, ESI, etc., etc. They make judgments, and it is possible that human judgments can go wrong. There is a possibility because the financial reporting consists of some judgment-based areas. We can't expect auditor to reduce the risk to 0 because we thought something. The thought can change. We thought, like, whenever a boy loves a girl, he thought that she'll be the one, but it can change. We don't know. That means what you think may change because it is a human tendency and human are tend to make the mistakes. So the preparation of financial statements involves judgment by management. That is why you are not expected to reduce audit risk to 0. And nature of audit procedures. There are multiple places where they tell that, as far as I said, 230. What is 230? Sorry, not 230, 530. Audit sampling. As an auditor, if you start doing the audit of some Reliance company, consider Reliance Smart is there. There they have a grocery, all those things. On an average, on a weekend days, they come around some 500 billings. Again, you do it for all the 365 days, that is for one store. Again, you multiply that for some, maybe some 100, 200, 300 stores in all over India. how much billing is happening. That is only for smart. Again, you should do digital. Again, you should do geo. Multiple things are there. That is why, as an auditor, I am not having sufficient team, or we are not expected to verify all those things because they are that is not possible. That trivial maybe. Trivial means very immaterial or small things, because of which auditor are not expected to reduce audit risk to zero. There are practical and illegal limitations on the auditor's ability to obtain the audit evidence management or others may not provide, intentionally or unintentionally, the complete information relevant for preparation of presentation of financial statements. That is why we are not expected to reduce audit risk to zero. When they don't give the information, how are we supposed to do that? Fraud may involve sophisticated and carefully disorganized schemes. Then timeliness and relevance. If you look at the audit, we should complete the audit. See, what is the due date of conducting an AGM? 6 months from the end of financial year, that is 30th September. To call the AGM, you should give a 21 days clear notice. That means at least you should give the notice by August 10th, not 10, maybe some 5th, or safer side I'm taking August 1st. Before that time, you should complete an audit. If as an audit firm, if you are doing only one company audit, then how can you survive? That is why generally a company or a audit firm will, a company subjected to audit maybe around some 70 days, 80 days, 90 days, maximum 100 days, depending on the size of company. Whatever the transactions they did with some 5,000 employees throughout the year, yeah, some 50 people going to the audit and verifying that in a 50 days. 5,000 employees, 365 days, transactions are verified by 50 people and in 100 days. What nonsense. That is why we don't have sufficient time to verify each and everything. That is why if you look at the objectives of the auditor, he should express an opinion stating that everything is free from what misstatements? Material misstatements. For small things, nonsense, irrelevant things, I just ignore it. That is why the moment we ignore something, if the fraud is there in that only, we don't know. Because of the sampling method we go, we can't express that everything is free from material misstatement. Unless until you verify 100%, you can't tell that the 100% is right. Why you can't verify 100%? Because of the or this timeliness as well as the fees being given. Relevance of information and thereby its value tends to diminish over the time. There is a balance to be stuck between reliability of information and its cost. And future event. What is future event? There are many places where company try to see, always financial statements are prepared on going concern basis. So what is going concern? We assume that company is a going concern for at least for 12 months period of time. Based on that, we make some assumptions and all those things. What if that turns out to be false? There are any future events are there, n number of future events that may cast a significant doubt on entity's ability to continue as going concern. That is why we are not expected to reduce audit risk to zero. Inherent limitations of audit. 5 points are there. First one is nature of financial reporting. Because the management judgments are being used in the financial statement preparation, we can't reduce audit risk to zero. Nature of audit procedures. Generally, we go for sampling and all those things. That is why we can't get the audit risk to zero. Then it is not in the investigation. Then it is relevant, timeliness and relevance of the information. And last one is future events. Future events are the points. These are the 5 inherent limitations of the audit. This benefits, you read it. This is also homework. Benefits and this one more thing we have given. You should read it. Overview of, not overview. What is this? What did I give as a note? Why standards are needed? These things. You should read these 2 things. And after that, you read key exam tips. I want you to read this benefits of audit just in a minute and read key exam tips. Then we can, I think, take a break, right? It's almost 9:50. If you want, we can continue. Complete one more standard and take a break, or we can take a break. You read it first. What time it happens, we will see it later. Today bank holiday, right? Done. So now we will discuss essay 210, agreeing to the terms of audit engagement. So 200 to anyway discussed now. What is the name of 200? Overall objectives, independent auditor and conduct of audit as per standards on auditing. So essay 210, try, you should remember, not try to remember, you should compulsorily remember name and number. So 210, agreeing to the terms of audit engagement, they mainly speaks about five elements. Five elements. First one is, what is this agreeing to the terms of audit engagement? See, whenever your client approaches to you for the purpose of offering you their audit, company audit, you should first come to a clarity that what is within your scope and how much money you are going to get and what is your responsibility and rights. Sir, can't we directly discuss it and finalize that? Yes, we can do that. But humans are always tend to change as per their favor. That is why it is better to put everything in a written format. The moment you put everything in a written format, whatever your rights and liabilities and their rights and liabilities, what is response, everything, then that takes the shape of written agreement. That written agreement is called as terms of audit engagement, that is audit engagement letter. So here, essay 210 is mainly talks about the objective of the auditor is to accept or continue an audit engagement only when the basis upon which it is to be performed has been agreed. See, look at the language I used. Objective of auditor is to accept. That means the client is offering the auditor to take up the engagement. The auditor should never go to the client asking the work. Client only should come to the auditor. So what? Establishing whether the preconditions for an audit is present or not. Only if that is present, then only can accept it, as well as confirming that there is a common understanding between the auditor and management, and where appropriate, TCWG with respect to terms of audit engagement. What is there in my mind? My mind talks about, sir, I should audit financial statements, I should give an opinion whether they are free from MMS and AFRF are complied or not. But client is thinking that, okay, he'll bring me lunch box, he'll take me on a tour trip. No. That means it is not in a common understanding. You should come to a common understanding. Then only agreeing to the terms of engagement, that engagement letter happens. So what has to be included in the audit engagement letter? Mainly the objectives and scope of audit. Whatever we discussed as per I said 200. Objectives of the auditor is to or this express an opinion or this express an opinion on the financial statements, whether they are free from MMS as well as prepared as per AFRF or not. That one. And scope of audit is financial related matters has to be confirmed, that scope audit which should not be included, that also should be mentioned here. Again, what is the responsibility of the auditor? Responsibility of the auditor is to verify all the books of accounts, financial statements, get the explanations wherever it is required, check the loss, check the financial statements, then express an opinion. And what are the responsibility of management? Responsibility of the management are like they should prepare the financial statement, they should comply with Schedule 3, they should comply with accounting standards, and they should take the responsibility for preparation. There are multiple things that has to be there. And identification of applicable financial reporting framework. If you are a banking company, tell that, okay, these financial statements are prepared as per what is this, Banking Regulation Act, or maybe insurance means IRD Act, company means normal Schedule 3. And the expected form and content of the report. How are you going to give the report? If everything is free from MMS, we will give unmodified opinion. If not, we will give modified, again qualified, those things. So these are the mainly overview of what content should be there in the audit engagement letter. What are those contents? Objectives, responsibility of auditor, responsibility of management, objective and scope, responsibility of auditor and responsibility of management, then identification of AFRF, and what is the form and content of audit report. These are the 5 elements has to be there. This is important. Now, and if you see here, we should accept an audit engagement letter only when the preconditions for the audit are present. What are the preconditions of it? Preconditions for audit are acceptable financial reporting framework. What is acceptable financial reporting framework? Whenever a company prepares their financial statements, the financial statements should be in a such form and such content should be there that which is acceptable to such type of entity. For example, normal company schedule has to be prepared, banking, everything that has to be prepared. Determine whether the financial reporting framework to be applied in the preparation of financial statements is acceptable or not. Being banking company, if you prepare using schedule 3 of company act, that is not acceptable. If they do it, then what is the use of you going and doing the audit? That is totally wrong structure only. That has to be there. Along with that, management should take management should agree for their responsibility. They should take the responsibility in writing. That obtain agreement of management. Agreement means acceptance of management that it is acknowledging and understanding its responsibilities. What is its responsibility as a management? The responsibility is they should prepare the financial statements and internal controls are working properly, and auditor should be given all the access whatever it is required. It is a duty of the management that has to be present. So first one is the preparation of financial statements is as per AFRS, and internal controls are placed to enable the preparation of FS that should be free from MMS due to maybe fraud or error, and providing the auditor access to all the information relevant to preparation of FS, additional information which is requested by the auditor, and you should give unrestricted access to persons within the entity. That means accounting manager, auditor want to talk to accounting manager, yes, you should give the accounting manager time that whatever explanations you need, he can get it. And limitations on scope prior to engagement. What is this limitation on scope? What is scope? Scope means what we are supposed to do, what we are not supposed to do. That should be excluded. What we are supposed to do, that should be included. The moment they are imposing some limitations, some restrictions, that sir, you can't verify P&L, you can only verify balance sheet, you can only verify cash flow, only first 6 months you can verify, only last 6 months you can. That means they are trying to put some restrictions or conditions. In that case, what you have to do? If the auditor believes that limitations will result in auditor disclaiming an opinion, that means not qualification, not adverse, disclaiming an opinion on the financial statement, then auditor shall not accept such engagement only unless until required by law or regulation. Generally should not accept it if there is a limitation prior to the acceptance of audit. But sir, if there is any limitation after acceptance of engagement, we will discuss that in essay 210. Here only it is there at the end. Now comes the recurring audit. See, this is also important for 4 marks. What are the preconditions of an audit? Recurring audit. What is recurring audit? For example, you are being appointed as an auditor as per Companies Act section 139. Yeah, auditor, if you are an individual there, individual can be an auditor for how many years? 5 consecutive years. If it is a firm of auditors, then it can be for 10 years. Now, 1 year you completed at the time of first beginning, you entered an audit engagement letter. Now, second year, do you need to enter one more engagement letter? Third year also one more, fourth year also one more. Is it required or is it not required? First of all, when an auditor is doing an audit of the company continuously for more than 1 year is called as a recurring audit. So that generally auditor should not send the same engagement letter on a continuous basis unless until there are some situations where you should compulsorily send that engagement letter whenever in case of recurring audit. So auditor may decide not to send a new engagement letter or other written agreement each period. Each period means each year. But there are factors which will make it appropriate to revise or remind. This is an 5 marks question. What are the situations where the auditor has to send the engagement letter again in a continuous recurring audit? First one is, one, the entity has misunderstood the objective and scope of audit. So that means they thought something else, we thought something else, that common understanding is not there between us. Or revised or special terms. Company earlier is having only what is this, 1 branch, now they added 1 more branch, they purchased 1 more branch or opened 1 more branch, because of which my scope has been increased. In that case, I should enter into 1 more engagement letter. Revise the special terms means, sir, earlier we were doing audit of only one branch. Now we are supposed to do audit of all the three branches. That means specially they are telling, sir, please focus on deposits areas, loan given areas. Special terms they are trying to tell. Okay, sir, we'll enter into one more engagement, then we'll focus on those areas. Or whenever there is a senior management change in senior management, why? Because the people who signed the engagement letter was only not there now. Now who should take the responsibility? That is why it is better to go for one more engagement later. Or significant change in ownership. Earlier, some party is holding some 30% of the company, is sold entirely, then when somebody has taken it, then enter into one more engagement later. Change in the legal framework. For example, earlier you are following accounting standards, now you are following Ind AS, required to follow Ind AS. Legal framework is also changed. Change in the financial reporting framework. For example, earlier you were an NBFC, non-banking financial company. Now you have become a bank. Then Banking Regulation Act has to be applied. Framework only changing now, NBFC to bank. Or change in the reporting requirements, or change in the nature and size of the entity. These are the areas in which makes mandatory to change the engagement letter. Not change means you should try to revise it as applicable to the current scenario. This is what the situations of audit engagement letter changing in recurring audit. Now, whenever I told that preconditions has to be present with respect to they followed AFRF, management taken the responsibility and the limitations is not there. But if the preconditions, whatever we discussed, if that is not present, our management is asking to change in the terms of engagement. Earlier they are telling, sir, we will give 10 lakh. Now they are asking, sir, I will give only 5 lakh rupees. Now earlier they told, sir, you can do audit for 90 days. Now they are telling, do it only for within 60 days. They are trying to change some terms of audit engagement. In that case, if the preconditions are not present, then the auditor shall discuss the matters with the management. You go and tell the management, sir, you did not take the responsibility for preparation of management. You did not prepare as per AFRM. You please go and talk to the management. Then auditor shall not accept the proposed audit engagement when the same conditions. If the auditor has determined that AFRF is unacceptable, unacceptable means different AFRF has been followed in the financial statements, or agreement of management is not obtained regarding preparation of financial statements as per AFRF. Internal controls enables financial statements are free from, you remember that preconditions, those conditions are not present, then don't accept it. Now request to change in terms, that means they're trying to tell that, sir, don't do this audit, you only do this part of the audit. They're trying to change the terms. In that case, as the auditor, you don't directly reject it, I don't want to change. You just first listen to the situation, sir, why? Explain me, convince me. If the explanation given by the management is convincing for you, then you do some other alternative procedures to complete that. If not, then you can withdraw from engagement. A change in the circumstances is there, then or misunderstanding of the nature of audit, or restrictions on the scope of engagement imposed by the management. If those reasons, whatever they are asking to change the engagement, if that is acceptable, reasonable justification has been given. In that case, if the auditor concludes that there was a reasonable justification to change the engagement, the auditor shall prepare a new engagement letter. Okay, sir, that old one we will tear it off, you will throw it, we will enter into new engagement and issue a report under revised terms. Don't go for earlier terms. To avoid confusion, the new letter would not give the reference to original engagement or work performed under the original engagement. That means you never give the reference to old work. If you already told to the shareholders that you already gave the report, now you should tell the reference. But when you did not complete only, we are talking about the beginning of the audit. So you never tell that, sir, we earlier entered the engagement letter, now we teared it off, again we entered one more engagement. No, don't tell anything. Unnecessary, don't create the confusion. Just as per engagement letter, do the audit, give the report. That's it, over. If the acceptance of change is not acceptable or no reasonable justification is being given, in that case, auditor should not agree and should tell management to continue the assignment. If not permitted by the management to continue, the auditor shall withdraw from the audit engagement where possible under law or regulations and report to the party such owner as TCWG. If not possible, tell the management not to change it. If they change it, withdraw it or something like that. That is what essay 210. Look at this thing. Online people, you take the screenshot of it. So now we will begin with professional ethics. Sir, what is ethics? First of all, ethics is something where it is a sense of morality, sense of consciousness. Ethics can't be imposed on anybody. Somebody likes to steal somebody's money, somebody likes not to steal somebody's money because they feel we should not get rich by somebody else's money. We should earn and we should spend. So ethics is self-conscientiable matter. It is not, you can't write some books on ethics and people will follow it. It is self-morality. ಒಬ್ಬರಿಗೆ ಇನ್ನೊಬ್ರಿಗೆ ಮೋಸ ಮಾಡಿದ್ರು ಖುಷಿ ಇರುತ್ತೆ, ಒಬ್ರಿಗೆ ಇನ್ನೊಬ್ರಿಗೆ ಮೋಸ ಮಾಡೋಕೆ ಖುಷಿ ಆಗೋದೇ ಇಲ್ಲ. ಸೊ this is entirely a subjective matter of these things. But whatever we are discussing the ethics, we are not discussing the personal ethics here. We are discussing the professional ethics. Whenever you are an auditor, what you should do it is, you should mainly focus on the, what is this, you should not compromise on at least these ethics. So the first thing which we have to understand here is independence. An auditor should always be independent with respect to the work he does. What do you mean by independent? Independent, or before that independence, we will discuss something called as fundamental principles of professional ethics. First, we will discuss these fundamental principles. There are 5 fundamental principles of professional ethics. Sir, what are those fundamental principles? This is an important examination for 5 marks. Can come in the examination. So first one is integrity, objectivity, professional competence and due care, confidentiality, and professional behavior. Sir, what is integrity? Integrity simply tells that being straightforward and honest. Don't care about anything. What is right, you tell it as right. What is wrong, tell it as wrong. Being always straightforward. Don't try to be a bucket raja in anything. So a professional accountant shall be straightforward and honest in all the professional as well as business relationships. Anyway, personal relationship you can't be straightforward. Even if your girlfriend or wife is wrong, you should tell that there is a mistake from your side only. You can't be straightforward. So at least in professional as well as business relationships, you should be straightforward. Integrity implies fair dealing and truthfulness only with respect to profession and business. Then comes objectivity. Sir, what is objectivity? Objectivity is nothing but auditor should not compromise on professional judgment. What is the objective of auditor? Express an opinion. Again, those two things, AFRF, MMS, all those things are there. So he should not compromise on his professional judgment because of what? Bias, conflict of interest, or undue influence of others. What is bias? Sir, auditor is appointed to audit some friend's company. He is trying to found some misstatements, but if he tells that something is wrong, his friend's company might what? Go into liquidation. No, he has a bias towards his friend. No, he should not have it. Objectivity means express an opinion, everything, whatever it is there. Just be a postman. Don't try to be a judge here. Again, conflict of interest. Maybe your relatives, this thing is there, or undue influence of others. In some cases, some companies will try to threaten you physically, emotionally, maybe financially, everything. Then you don't fall for those things. You just tell what is there, what is not there. That's it. So objectivity, don't compromise professional judgment because of biasness, conflict of interest, and undue influence. See, at least this what should be there in the examination. I know that it is too much in the regular content, but at least this has to be there. Put some extra masala here and there back and then try to underline the important lines and write it. Then comes confidentiality. What is confidentiality? Auditor should always maintain the information which is obtained. See, when I say I am an auditor, when I am going for the audit of Reliance company, I am exposed to very secret documents also. Whatever the decision taken in the board meeting, whatever the minutes of the meeting, what is those financial statements are prepared, what assumptions there, everything I am exposed. Why? Because people trust us. That trust I have to keep it by way of maintaining the confidentiality. Even then what? Even at the time of when you are alive, you should make it confidential. When you are dying, then also you should make it confidential. The moment you are dead, then also you should make it confidential. You should not go and tell anything in your heaven also, because they should not come to next life and go to so even this, no, I am not exaggerating the things. They are telling even after the death also you should not disclose anything. So how can somebody disclose? We don't know it. Maybe spiritual parties will tell that. Or this. Okay, whatever the secrets we have, that secret should also be a secret. Andre mannalli mannage hogbidಬೇಕು secret ಯಾವತ್ತೂ ಹೊರಗಡೆ ಬರಬಾರದು ಅಂತ ಹೇಳ್ತಾರೆ. That's why we call it as confidentiality. But there are some requirements of an auditor to disclose those information too. Whenever it is required by the law, then he has to disclose it. Or whenever the authorities or it is a professional duty of an auditor to disclose it to the authorities. For example, CBI raid has come to a client place, then you should disclose it. When they ask, if you tell that confidential, then they'll then they'll tell requires a professional accountant to respect the confidentiality of information acquired can be disclosed when it can be disclosed. This means it is an exception when required by law or when there is a professional duty or right to disclose it, for example to authorities. Then professional competence as well as due care. Sir, what is this professional competence and due care? Professional competence tells that, see, as a 10th pass student, I can't do the audit of some company because I'm not competent person. For the purpose of becoming an auditor, we know that the eligibility is only CA plus having COP, certificate of practice. Just because having CA and COP is also not enough. You should be competent enough to do the work. Whenever you're going for a bank audit, if you never done that bank audit in your lifetime, then you are not competent person. You don't have sufficient skills and resources. So that minimum eligibility is at least to be a CA. That specialization will keep it aside. So you should try to acquire the knowledge. Second part is you should try to maintain that acquired knowledge. Maintain means update. Keep on updating whenever the regulations, whenever the amendment comes, you keep on updating. That is what we call it as professional competence and due care. What is due care? Try to, what is this? Professional accountant shall attain and maintain. Attain means acquire. Maintain means continue. Professional knowledge and skill at the required level, whatever the level required. For example, if I do going for bank audit again ಬೇಕಲ್ಲ ನಿಮ್ಮ ಕಡೆ ಇರಬೇಕು. Insurance company audit, insurance knowledge. Diligence includes responsibility to act carefully, thoroughly and a timely basis. Then professional behavior. What is professional behavior? Whenever you are going for an audit, you should not do something which will discredit the institute or profession. What is meant by discredit the professional institute? Whenever you are going the audit, you are going in a shorts and you are going in one polo t-shirt, that round, not polo, round neck t-shirt. This smoking, drinking. No, you don't. You behave professionally. You are a professional man. You don't tell ba macha will go to lunch. No, don't talk to CEO like this. You are a professional. You be professional with respect to your work. That is what professional behavior. Behaving in a professional manner. Don't behave in such a manner that which will bring a disreputation to the institute or profession. ನಿನ್ನ ಸಲುವಾಗಿ CA ಮರ್ಯಾದೆ ಕಳಿಬಾರ್ದು ನೋಡ್ರಿ, ಹಿಂಗೆ ಮಾಡ್ಕೊರಿ ಅಷ್ಟೇ. That is what professional behavior. So requires an accountant to comply with relevant laws and regulations and avoid any conduct that might discredit the profession. That has to be taken care. These are the 5 fundamental principles of the auditor or professional accountant. Now along with those 5 things, auditor also has to maintain always the independence. With independence, there is one more thing called as professional skepticism. Sir, what is this independence? Whenever you do the audit, in the integrity only we told, sorry, not integrity, objectivity. You should not base your judgment based on a lack of bias or conflict of interest or something else. Here also independence means don't accept such engagement or don't continue such engagement where you feel your independence is already compromised. Sir, where my independence is compromised? For example, if you are auditing some company, in which your friend is only CFO or CEO, that means the people who first of all you only think that oh, my friend is there, if something he requests, my friend should, at least okay, the moment you decided to go for something, okay, ಇಲ್ಲಿ ಏನಿದೆ ಅದನ್ನೇ ಹೇಳ್ತೇನೆ ಅಂತ ನೀವು ಡಿಸೈಡ್ ಮಾಡ್ಕೊಂಡ್ರಿ ಅಂದ್ರೆ either you lose the friendship or you lose the audit of client. Only things can happen. Why you go for that thing rather than coming to the first part? Don't accept the engagement only. First of all, try to be independent by yourself, or don't accept such engagement where your independence is being compromised. When I say independence, independence is of being free mind, no biasness, no what is this, influence, no threatening, nothing is there. When I say independence, independence are of 2 types of independence. One is independence of mind and independence of appearances. What is independence of mind? Independence of mind, they are talking to tell that at least you should not feel that your independence is compromised with respect to the audit. Independence of mind means in your mind you should not get that thought, he is my father, he is my brother, he is my friend, he is my relative. No, if that is coming into your mind, don't accept it. What is independence of appearance? Consider I am going and doing an audit of some company. Consider the person whom I am doing the audit is my friend only. In my mind, I know that I never compromise my professional ethics. My independence is always there. But we are such close friends that people, whoever is, they see it, they feel that, oh, they are friends now, they will take care of one another. That means your appearance, whatever, the way you appear to the public is always compromised. That should not be happening. So independence of mind as well as independence of appearance, both should be there. So independence implies that judgment of a person is not subordinate to the wishes or directions of another person who might have engaged him. If company tells that give me unqualified, you should not give it. If they really worth unqualified opinion, you should give it. You are not subordinate to somebody, you are boss of your own work. And independence of mind and independence in appearance. Independence of mind means it is a state of mind that permits the expression of conclusion or opinion without being affected by influences or compromises on professional judgments. That means within you only, they should not influence you. What is appearance? Appearance means the avoidance of the facts and circumstances that are so significant. So independence of appearance, you are avoiding such facts and circumstances that are so significant. When somebody comes and tells that, sir, in this company this is missing, you try to, okay, it's okay, let me handle it later. That means you are avoiding such facts that a reasonable informed third party, any party with a common sense, is trying to understand that firm or audit team members' integrity, objectivity and professional skepticism has been compromised. That means it is like a corrupted officer. Whoever is the officer, when you go and give the information, they try to tell that, okay, let me take care of it. That means they are already colluded with the people. The people, if you appear to be in this way to the third party, then it is not going to happen. So when I say independence, there are some threats to independence. This is also a 5 marks important question. 5 marks important question. What is threats to independence? You want to be independent, but there are certain situations where it is not allowing you to be an independent party. Sir, what are those threats to independence? There are 5 threats to independence. One is self-interest threat, self-review threat, advocacy, familiarity, as well as intimidation threat. Sir, what is this self-interest threat? Self-interest threat is a threat in which because of maybe some financial requirement, or maybe because of the long-term employment, or maybe because of the financial interest in the client, or maybe because of the loan or something like that, you are compromising your independence. Your independence can't be exercised, or there is a threat to independence. For example, I am appointed by some XYZ company, or not consider, I am appointed by maybe Reliance company as an auditor. I took some 100 crore rupees loan from Reliance company only. That means if I don't do the work they ask me to do, definitely they'll ask me to pay me 100 crore rupees back. Where should I bring it? Because of which I might not exercise my independence in an audit. That is why you try not to, better, because of it. Section 141, you remember disqualification of auditor, more than 5 lakh rupees indebtedness, more than 1 lakh rupees of, no, that should not be there. That is why you should try to be more these things, independent with respect to the entity in which you are auditing. It occurs when an auditing firm, its partners or associates could benefit from financial interest in an auditing firm. Mainly financial interest only, that is what is this, affecting the independence of parties. Examples like direct financial interest in a client, potential employment with a client. Okay, sir, you give me audit report as per what I want. I'll give you 2 more companies to do the audit. That means potential. Potential means future. Or loan from the client. In these cases, your independence might get affected. Better be away with respect to this threat. Then comes self-review threat. What is self-review threat? Whenever you are an auditor, to do the audit of the work which is performed by you only, or your team, or your firm, then you might not give it the right opinion, because if you find out some mistakes, you are trying to find out the mistakes of the work you already done it earlier. That means you are trying to review yourself. Whenever my what is this, I do some work, for example, okay, that's okay, not going to example. It occurs when an auditor has recently been a director or senior officer of a company, or when the auditor performs services that are themselves the subject matter of the audit. ನಾನು ಮಾಡಿದ ಕೆಲಸಕ್ಕೇನೆ ನನಗೆ ರಿವ್ಯೂ ಮಾಡಕ್ಕೆ ಕೊಟ್ಟು ಅದು ಯಾವತ್ತೂ ವರ್ಕ್ ಆಗಲ್ಲ. That will definitely affect the independence. Even I find the mistakes, I not try to report it to the company, because I don't want to punish myself by doing this thing. Then advocacy threat. What is advocacy threat? Before advocacy, you look at the familiarity threat. Familiarity threat. What is familiarity threat? You as an auditor has become too sympathetic. ಇಷ್ಟು ಕರುಣೆ, ಇಷ್ಟು ಮನೋ ಏನದು ಬಂದ್ಬಿಟ್ಟಿದೆ ನಿಂಗೆ ಅವನ ಮೇಲೆ, ಇರ್ಲಿ ಅವನು ಬದುಕಲಿ ಅಂತ ಹೇಳಿ. ನೋ, ಯು ಶುಡ್ ನಾಟ್ ಗೆಟ್ ದಟ್ ಫೆಮಿಲಿಯಾರಿಟಿ. ವೈ ಸರ್, ಅವ್ನು ನೋಡಿದ್ರೆ ಅವ್ನು ಬಹಳ ಕಷ್ಟ ಇದೆ, ಪಾಪ ಹೆಂಡತಿ ಮಕ್ಕಳು 4 ಜನ ಮಕ್ಕಳಿದ್ರೆ ಹೆಂಗೆ? ನೋ, ಡೋಂಟ್ ಬಿ ಸಚ್ ಥಿಂಗ್ಸ್. You should not, I gave the exaggerated example. See, when you be in the contact with the client for maybe some 5 years or 10 years, then you might become like a friend, because on a regular basis, year on year, you continuously are talking to him, you are going on a lunch, or you somewhere you are happening. In that case, that is why the familiarity threat occurs when the auditor forms a relationship with the client where they end up being too sympathetic to the client's interest. Example, close relative in a senior position or long association with the client. Long association means continuously doing the audit. Then also you should, it will affect your independence. Then advocacy threat means what? You advocacy, like, advocate means arguing against you, sorry, in favor of you, or against you also the other advocate. Now you advocated the company's interest or company's financial position to such an extent, the outsider is thinking that, oh, you marketing madakatale as auditor, that means his objectivity has been compromised. If that comes, then that means you are advocating the client. So it occurs when an auditor promotes a client's opinion to a point where objectivity is seen as compromised. For example, dealing with the client's shares or securities, becoming the client's advocate in the litigations, etc. Then last one is intimidation threat. Sir, what is this intimidation threat? Mainly with respect to what is this? Threatening, physical threatening, mental threatening, all kind of those things. It occurs when auditors are deterred. Deterred means stopped from acting objectively with adequate professional skepticism. Example, threat of replacement over accounting disagreement, threat of reducing the audit fees, some threat. Whenever you get that, try to implement some safeguards for those threats to independence. So what is that safeguard? General requirements is like, it is essential that auditor should always be and appear to be independent of entities that they are auditing. Even when you know that you are auditing, you are going to audit some relatives company, first don't accept only. You should try to be a totally independent party. Before accepting the work, the auditor shall consider whether it involves any threats to his independence. Is there any person related to the company? Did I do any other work already in the company? Self-review threat, all those things. You consider those things. When threat exists, when there is, you come to know that there is a threat exists, then the auditor should do what? Relieve from the task. Relieve from the task means what? Okay, relieve is the third option. Try to eliminate the threat. What do you mean by try to eliminate the threat? See, try to eliminate the threat does not mean that, for example, you recently got married or married some 5 years back, and your father-in-law is offering a company audit, his company audit. When I try to eliminate that threat, it doesn't mean that you should give the divorce to your wife and do the audit. I know that there's a threat. You should not eliminate that threat. You should try to eliminate the threat which is with respect to the audit. That means don't accept the engagement on it. That is what eliminate. Or try to put some safeguards to reduce the threats to an acceptably low level. For example, some companies being offering audit to you, but your relative has purchased 1.5 lakh rupees worth of face value shares. As per section 141, a relative can hold maximum of 1 lakh rupees worth of face value. That means try to bring that up to an acceptably low level. What is acceptably low level? You request the relative, please sell 50,000 worth of face value shares so that I can be appointed as an auditor of the company. So take an acceptable. If that is also not possible, then relieve from the task. Generally, relief from the task happens when you are already appointed. Later, your somebody will purchase the shares of more than 1 lakh. Then you should resign, relieve from the task. Eliminate the threat, or try to reduce it to an acceptably low level, or relieve it. If the safeguards are inadequate, that means your wife is not giving the divorce only. Then the auditor is unable to fully implement credible and adequate safeguards. Then he must not accept the work ultimately. These are some safeguards which has to be there. We discussed what is ethics, introductory part, fundamental principles of ethics, independence, threats to independence, and safeguards to threats to independence. Last one is professional skepticism. Sir, what is this professional skepticism? Always being alert in whatever you do. Whenever you are verifying the PP, I think I gave an example in the class. Once what happened is, some auditor is walking on a lobby, like entering the company, then he saw that on the right side and left side there are 2 ACs in the company. When he went and saw that books of accounts and financial statement, they found that 4 ACs are there. That means, sir, how the moment he looked at 4 ACs, he immediately found out that there is a misstatement. Why? Because he was alert when he was doing any work in a company. being alert to all the situations. Whenever somebody makes a statement, try to listen it carefully. Whenever somebody gives some financial statements, financial information, try to read it carefully. Professional skepticism means always being alert to all the situations that is possible to create the threats to independence. So, professional skepticism is not some rule, it is an attitude that includes a questioning mind, being alerted to the conditions which indicate possible misstatement due to error or fraud, and a critical assessment of the audit evidence obtained. Whenever somebody gives an evidence, you don't just accept it. Try to verify whether it is genuine, fake, or something is there, kind of thing. So, the moment you are professional skepticism, how can you reduce? The moment you are more alert to situations, it will reduce the risk of overlooking unusual circumstances, or it will even reduce the risk of overgeneralizing when drawing conclusions from the observations. Like overgeneralizing is like, okay, this is correct now. Okay, yeah, consider that everything in that row is correct. No, don't generalize it. Everything is specific part. Or it will even reduce the risk of using inappropriate assumptions in determining the nature, timing, and extent of audit procedures. This is what the use of professional skepticism. This is also important. Whatever I gave, all the questions are possibility in the examination in simple concept only, professional ethics. So this is there. You can, online people, you can have a look into or take a screenshot of this exam tips. So we will see you in the next video. So now we'll continue and discuss 700 series. So we'll do the reporting part. After that, we'll go to some other standard. First one is SS 700. SS 700 is mainly talking about forming an opinion on the financial statements and reporting on the financial statements. So as the main objective of the auditor is to express an opinion, for expressing an opinion, first of all, you should form an opinion. On what? On the financial statements. After that, you should express that as an opinion. So this 700 mainly talks about two things. What is the form of opinion in the on the financial statement that is to be there, and you should express that clearly through opinion in a written report. You should come to a conclusion, tell that conclusion to the people in a written report. That is called as 700 mainly. So this financial reporting framework we actually discussed in basic fundamentals chapter. So that you can go through that. I'm just tell that a company can has to apply compulsorily applicable financial reporting framework. Sir, what is applicable financial reporting framework? There are two types of framework. One is fair presentation. Sorry. There are two types of financial statements. One is general purpose financial statement. Second one is special purpose financial statements. So what is general purpose financial statements? Any financial statements which is prepared using general purpose framework is called as general purpose financial statements. Sir, what is general purpose financial framework? General purpose framework. General purpose framework means we are discussing because 95 more than 95% of the companies or entities in the India are using general purpose framework only. Special purpose is mainly prepared for some specific users like banks, loan, for the purpose of loan or government, anything they are being prepared. So mainly financial reporting framework means general purpose framework I am talking about. So general purpose framework are there consisting of two types of framework. One is fair presentation framework. Second one is compliance framework. Sir, what is this compliance framework? Whatever it is given in the law, just follow it. Don't try to deviate here and there for better presentation. The word true and fair will not be present in case of compliance framework. But the word true and fair will be present in fair presentation framework. And if you feel something is a better way to present it in a financial statement for a better understanding, you can deviate. You can follow the rules and you can deviate the rules also and try to do better presentation with respect to financial statement. Now as an auditor, you should do what? First of all, you should form an opinion on the financial statement. Form an opinion on the financial statements. The general requirements are the auditor shall form an opinion on whether FS are prepared in all material respects. Financial statements are prepared in all material respects in accordance with AFRF or not. It is like the introductory essay 200 part. Again, there are some conclusions he has to take into account. That whenever before you express an opinion, whether as an auditor did you obtain sufficient and appropriate audit evidence? Without obtaining sufficient and appropriate audit evidence, there is no reasonable assurance you are having. When there is no reasonable assurance you are having, then you can't express an opinion. That is why you should be always make sure that you have sufficient and appropriate audit evidence, and whether the uncorrected misstatements are material or not. Whenever you are doing that, you found out some misstatements here, told to the company, but they did not correct it yet. That is why we call it as uncorrected misstatements. Those uncorrected, is it material or is it immaterial? If it is immaterial, just what is this? Ignore it and proceed further for giving an opinion. And whenever you should evaluate even the qualitative aspects of entities accounting practices. Again, whether financial statements are prepared as per AFRF, what is this one? Depending on the type of company or type of entity where you should prepare your financial statements as per that act. And specific requirements of this essay is being followed or not, you should keep in mind of these things. Then some qualitative aspects are there. Sir, you told evaluation of qualitative aspects, or what are those evaluation of qualitative aspects? So evaluation of qualitative aspects are, you remember that inherent limitations of the audit. First one is management judgment is there. The similar point is there here. Management makes numerous judgments about the amounts, disclosures in the financial statements. That is why the auditor may become aware of the possible bias of the management judgment. If he feels that management has done some biasness with respect to presentation somewhere, not presentation somewhere, then we call it as qualitative. What is qualitative, you tell me? Other than quantitative is qualitative. What is quantitative? Sir, this is 100, this is 200, this is 300. Evidence is available, that is quantitative. Sir, we are not able to estimate what is the litigation amount. We think, we feel, that is qualitative. You should be very, very careful, because management is always in a situation that whenever they feel that, even they know that there is outflow of some 10 crore rupees, they try to make it as lesser amount provision, because so that they can show the higher amount of profits at that year. So because they have a biasness towards their against things compared to the favorable things. So the auditor may conclude that lack of neutrality together with uncorrected misstatements causes the financial statements to be materially misstated. So some indicators are with respect to identifying how the qualitative aspects are correctly considered or not. Selective corrections of misstatements brought to the management's attention during the audit. That means auditor is asking something, but the management is telling what they want to tell. What that is asking is not being told. Auditor is asking 10 elements, management is telling only 5 elements. Only selective items they are doing that. And possible management bias in making accounting estimates. They estimated, they should actually estimate 10, but they estimated only 2 crores. Biasness. Those are the things. Some specific evaluations required by auditor, you can go through that later. Now comes, this is not exactly directly being asked in the examination. Whatever we are going to discuss now, that is being maybe section wise being asked in the examination. This part contains reference to almost many sections. 701 also contains, 705 also, 706 also, 710 also, 570 also, 260 also, 560. Many sections standards are being cross referred to these things. But in this video, we will stick to what is required to be done. Then we will finish out this 700. So elements of audit report, or you can write it as format of audit report. Format of audit report. Now, audit report generally should consist of these elements in the auditor expression of opinion. First thing which has to be there is title. So first we will go through the headings, title. After that, there should be addressee. That means to whom you are giving the report, that should be there. And what is your opinion on the financial statements with respect to law, with respect to your opinion. Then comes, sorry, you are telling that is right, this is right, and what is the base? Sir, because I verified this is not corrected, it is not as per Companies Act, this is not as per accounting standard. What is the basis for opinion? After that, you have to check even going concern also. Going concern is discussed in 570, SA 570, whether the company is a going concern or not, or is there any situations or circumstances which is leading the company to affect their going concern. Material uncertainty is there with respect to going concern. After that, whenever you talk some matters to the TCWG, out of that matter, you felt something is important for understanding of this thing. So you put it as a separate heading called as key audit matter, that is discussed in 701. Later, you should tell that as per SA 210 also we discussed, here also we are discussing, it is the responsibility of the management to prepare the financial statements. You tell it in the financial statements audit report also. that users will come to know that who has to prepare the financial statements, who has to approve the financial statement. After that, you tell even what is your responsibilities also with respect to audit of financial statements. Then what are the other reporting responsibilities? Mainly Companies Act. Section 143 is there, then CARO is also there, etc. etc. Reporting requirements are also there. 143 fraud reporting is there, CARO reporting is also there, except for some companies. Then after everything, you put your signature. You auditors address, actually this is not required. We call it as place, signature, place of signature, and the date of audit report. Date of audit report. This is what the entirely content of audit report part. Whatever it is there, okay, there is one more thing. The lastly it should contain UDIN. This is one separate part. So what is the separate part? Whenever we told that you should also include the auditor's responsibility in the audit report. Where should you include audit responsibility? Is it within the body? Is it outside? Or is it somewhere else? Attach a paper, something. What is that is being given? That is separately not part of audit report format part. First, when I say title, the title of the audit report should always be consisting an heading called as it is an independent auditor's report. Always means always. You can't tell it as dependent auditor's report, because the moment you tell dependent, if professional ethics are compromised, you are ineligible to do the audit. First of all, independent auditor's report only. Then you should address it to the people whom this report is prepared. So to whom this report is prepared? Report is to be given for the people who appointed you. If the shareholders has appointed you, give the report to the shareholders. If the government is appointed, CAG is appointed, to give it to the central government or President of India. So to those whom the report is prepared, it is often to the shareholders or generally TCWG, or you can write it as government. C&G is part of government only. It is given to government. Then comes opinion. When it comes to opinion, you should do the audit. Whenever you are doing the audit, first you should come to an opinion. Before expressing your opinion, you should state certain matters as per standards and auditing, that is 700. What matters in the first paragraph of any audit company, you see it, they tell that you should identify these 5 items first, then later you give your opinion. I simply display it. I am not going to read entirely. It is just for your understanding. If I go for the Reliance audit report, see, if I go for the Reliance audit report, the heading is Independent Auditor's Report. Again, it is given to the members of Reliance Industries Limited. Report on CFS, they are giving, okay. SFS is also there before this. Opinion they are giving. In the opinion, they should identify 5 elements. After identifying the 5 elements in this first paragraph, then they are telling, in our opinion, something to best of our knowledge according to explanation given to us. Then I am telling my what I felt. But this first paragraph is mandatory for all the company's auditors. Sir, what are those 5 elements which has to be there? That auditor has to identify the name of the entity whose financial statements are being audited. That means if you are being an auditing the Reliance company, you tell that we audited the Reliance Industries Limited, that you tell the name. After that, you identify the title of each financial statements. What are the financial statements? 5 financial statement items are there. We audited the balance sheet, P&L, cash flow statements, SOC, notes of Reliance Industries Limited. Identify both the things. Again, you give the reference to the notes. That means notes to accounts is also there. That you give the reference to the notes. Again, state that financial statements are audited. We have audited FS, that is balance sheet, P&L, everything of Reliance Industries. And you should also specify the period and date covered by the audit. We audited the balance sheet as on 31st March 2025. Those things has to be 5 things which has to be specified. They can ask this as an examination question. They may ask what are the elements which has to be identified as an opinion section. First, identify the name of the entity whose financial statements are being audited. Identify the title to each financial statements. Reference to the note. State that financial statements were audited and specify the period or date that is being covered by the audit. 5 things. If you go to the Reliance audit, I am not reading everything. I need 5 things. First one is you should identify the name of the company. You should tell that you have audited it. You should even identify the name of the financial statements, that is cash flow, P&L, balance sheet. You should even identify the period also. You should even give the reference to the notes also. Notes to the consolidated financial statement. These are the 5 elements which has to be identified by auditor in the opinion section. After that, I done audit. This is what you have to give it. This opinion section is also being asked in the examination for 5 marks. Recently being asked. But opinion, when we are going to discuss this, when we go to 705, then we will discuss that how do we form the opinion section part there later. After that, giving the opinion section, you should even go through basis for opinions. Or what is basis for opinion? You are telling that everything is correct, everything is not correct. What is the base? Because of these things, you state that audit was conducted as per standards and auditing. A reference to the auditor's responsibility section also being given. Statement that auditor follows independence and ethical requirements, that also has to be told. And state whether sufficient and appropriate audit evidence are obtained. Based on these 4 items, my opinion is this. You should tell this basis as basis. After that, going concern, we will discuss in 570. If you want this going concern to be discussed, you please watch the video. It's a 570 which is being uploaded. Then come to key audit matters. What are key audit matters? They again we will discuss the same things in 701 also. Separate video is there for 701. Again, you try to see this. Key audit matters are some matters which auditor felt important in audit of the financial statements, and those are the matters which are selected from the matters communicated to TCWG. That is what we call it as key audit matters. So for a complete set of financial statements of listed entities, or if the law or regulation tells that you should give 701, or if the auditor to report key audit matters as per 701, then you should follow that thing. In detail, we will discuss in 701. Then management responsibility section. Anyway, we discussed in essay 210. You remember that the management has a responsibility to prepare the financial statements, approve the financial statements, follow the accounting standards, as per AFRF, everything has to be taken. So management has to state the responsibility of management or TCWG, if the management and TCWG are different, that preparation of financial statements is done as per the applicable financial reporting framework. They did not compromise here and there. Then they designed and implemented and maintained the internal controls of the company also, that none of the accounting transactions or records are being violated or overtaken. What do we call it as that exact word? Modified without authority kind of thing. As well as they should assess the entity's ability to continue as going concern. Whether they are going concern or not for the next 12 months, they should assess it. In the management responsibility section, at least you write these 4 points. The similar things which we discussed in 210 also. Then again, you should tell that it is responsibilities of auditor. What is the responsibility of auditor mainly? He should do audit as per standards and auditing. He should get sufficient and appropriate audit evidence, always be independent, always exercise professional skepticism, try to identify the risk of material misstatement, check that whether going concern assumption that is made by the company is correct or not. Whatever they did, checking that is correct or not, that is what my responsibility. So you should always maintain an attitude of professional skepticism and professional judgment. You should try to identify and assess the risk of material misstatement. You remember that in objective of auditor, we told that auditor has to assess, identify whether the financial statements are free from ROMM, risk of material misstatement. That is what it is there. You should try to obtain an understanding of the internal controls, how the internal controls are being operating in a company. Obtain an understanding. Check the accounting policies and estimates. Is it as per the applicable financial reporting framework or not? And is it acceptable or not? Are they made for too exaggerated claims with respect to those things? Has to be checked. Again, check the ability of continue to as a going concern, whether they're telling sir we are going concern. If you look at the Air India report, they're telling it is going concern, even though they are sufficiently continuously having continuous losses. At one point of time, on a yearly basis, they were making some 6-7,000 crores of loss per annum. At one point of time, they had accumulated losses of 60-70,000 crores. Still, they were preparing the financial statements as going concern. Why? Because government of India has given the guarantee for that. That you have to assess whether that going concern is correct or not. Whether in the loss also that is correct, in the profit also that might not be correct. You should assess based on your professional judgment. Again, check the structure and presentation of content of financial statements. That means structure means what? Financial statements. We have now vertical format. Equity, liability, assets. If it is indexed, exactly opposite. First assets come, then equity, then liability comes. Is it as per the structure? Then contents. Contents means what? first 10 property, plant and equipment should come, next item, or all the items are containing this or not, everything has to be checked. Determine the matters communicated with TCWG. That is what it is there. Now, along with that, audit also has to give the reporting requirements other than standards also, that is 143. 143 consisting of three main subsections, 143 1, 143 3, then 143 12. These are the main three subsections that they have to report. Then Companies Act others, in case of companies, reporting under CARO, if it is applicable. For few companies, it is not applicable. If for this, you watch the CARO video. After that, you put your signature. Sir, what do you mean by signature? If you are an individual signature, you write your personal name, you sign on top of that personal name. But if you are a firm of auditor, consider ABC firm is being appointed as an auditor, in which A also, B also, C also partners are there. Now, individual partner will sign in his personal name on behalf of the firm. So, signature in his personal name and in the firm's name also. Proprietor or partnership membership number also should be assigned by ICA, that also should be mentioned. For example, some 6-digit number will be there. In case of firm registration number has also to be mentioned. If you look at the Reliance audit report, key audit matter, everything we will, you can go through that. So if it is a firm, Deloitte Haskins, chartered accountants, firm registration number, Abhijit Damle, partner, membership number, and lastly Udin and the place also there, date also there. Anyway, we are going to discuss that next. Again, Chaturvedi Shah is also there, chartered accountants, FRN is there, Sandesh Lada is there, partner, membership number, Udin, place and date, everything is there. See, in the regular class, we discussed at least for some this 700 series only, almost some 20 hours we discussed, 700, 705, 701, everything. Date of place which has to be there, wherever you sign the audit report, that should be the name of the city. Then date of auditor's report, date of signing the audit report should be there whenever you sign that. It should not be dated earlier than the date of obtaining a sufficient and appropriate evidence, which is in which you base your opinion. See, you obtain an evidence, after that you get a conclusion, after that you express an opinion. Before you get the evidence, you express your opinion, then there is no use. Then informs the user that the auditor has considered the effect and events and transactions which have become aware and occurred up to the date. That means whenever you are auditing, from the date of balance sheet, if there are any events which has occurred after that, you consider that also, whether it is adjustable event, non-adjustable event, all those things are considered, and you give the audit report. This is actually a 3 marks question. See, all the items in this content is important. They can ask anything. After that, you should give UDIN number. Auditor is required to mention the UDIN with reference to each audit report being signed by him, along with his membership number while signing the audit report. So, where is the description of auditor's responsibility? That means, if you look at the Reliance audit report, auditor's responsibility is given within the body only. Responsibility of the auditor with respect to consolidated financial statements. They gave those responsibilities here, everything they have given. But if you see here, they told there are 3 places where you can mention your auditor's responsibility. First place is within the body, what it is given in the Reliance Limited, or you can put it as an appendix or attachment to the audit report. Separate paper, put it and attach it to the audit report. Or if there are your responsibilities already specified in under some regulatory authority, you copy that link of regulatory authority, put that authority link here. Tell that whatever the responsibility given under that authority is obtained, the same responsibility is auditor's responsibility. That is within the body of a report, within an appendix to the auditor's report, by a specific reference with the auditor's report to the location on a website of an appropriate authority if permitted by law or regulation. Generally, in India, we follow body of the audit report or appendix. Appendix is also very rare. Generally, body only, within that only they want to give it. This is what essay 700. Online people, you can take a screenshot of it. We'll see you in the next video. Now we will discuss essay 705, modification to the opinion in the independent auditor's report. So 705 is modification to the opinion in the independent auditor's report. Sir, what is modification to the opinion? See, auditor don't want to modify his opinion when the financial statements fulfill their objective. What is objective? If the financial statements are free from material misstatement and prepared as per AFRF, then he don't want to modify any opinion. But when some conditions which are required to be present, if they are not present, then definitely auditor will try to modify the opinion. Sir, what modification he'll do, why modification will be done, what types of modifications are there, everything will be discussed here. So, it is 705, he tells that to express clearly an appropriate modified opinion on the financial statement that is necessary. When it is necessary, when auditor concludes that means he concluding that based on the evidence he has obtained, that financial statements are as a whole are not free from material misstatement. That means he finds after verification of financial statement that misstatements are present in the financial statements, or he was not able to obtain evidence only. When he is not able to obtain evidence to verify the financial statements, how can he tell that financial statements are free from material misstatement? That is also when the auditor will modify his opinion. The auditor is unable to obtain sufficient and appropriate audit evidence to conclude that financial statements as a whole are free from MMS. One, he got evidence and concluded yes, it is not free from MMS, or is not able to get the evidence to tell that it is free from MMS. That means he indirectly assumed that there is something fishy, that is why they are not giving the evidence. Under those two situations, auditor will modify the opinion. What is the reason, causes for material misstatement? Inappropriate accounting policy, inappropriate accounting and accounting policies, application of accounting policy, or inadequate disclosures. Unable to obtain sufficient and appropriate audit evidence. Now, why? Because management is putting some limitations. They are not allowing the employees to come give the explanations, are not giving the full financial statements, or circumstances are beyond the controls. That means auditor wanted to do the audit, company also want to give the details, but the records are destroyed due to fire. That is not within everybody's control. So, are circumstances relating to the nature or extent of timing of auditor's work. Because of these things, he is unable to obtain sufficient appropriate audit evidence. That is not important from examination, only this is important from examination point of view. 705 objective. Then, sir, what type of modification I have to do? What type of modification I have to do now? Modification depends, type of modification depends mainly on two factors. One is materiality of an misstatements and pervasiveness of a misstatements. Sir, what is materiality of a misstatement? Materiality means anything which is there, which is affecting significantly the decision of the users of the financial statements. For example, in the financial statement, some 20% of the inventory is misstated. Yes, 20% inventory is significant. Yes, it is significant. That is what we call it as materiality. Anything which is relatively significant. Significance means more of the matter for decision making for the user, or pervasiveness. What is pervasiveness? Pervasive is like more bigger effect on the financial statement. Sir, significant means material inventories are misstated. I agreed. But if the inventory also misstated, PP also misstated, liabilities also misstated, loans also misstated, equity, everything is misstated. The effect on the financial statements is on multiple items, and that item's effect is so big, na, that is 70, 80, 90% of the financial statement. That is why we call it as pervasiveness. See, it does not mean all the items of financial statements are misstated. Consider financial statements is there. 90 crore rupees is PPE, 10 crore rupees is inventory. If 90 crore rupees fraud is there, that is also pervasive, because 90% of the financial statements are misstated. So, effects are not confined to a specific elements of financial statement. That means only one item is not misstated. Misstatement is there in many items. Or if it is there with respect to only one item, then also it is representing a substantial proportion of the financial statements. 90%, 80% of the item is financial statements is that item. In relation to disclosures are fundamental to the users of the understanding of financial statement. That is what we call it as pervasiveness. Now, what type of modification we are supposed to do? Type of modification mainly depends on, there are three types of modification of opinion. Three types of modification of opinion. What are those three types? One is qualified opinion. Second one is adverse opinion. Third one is the disclaimer of opinion. It is not opinion. Disclaiming the opinion or not giving the opinion is called as disclaimer of opinion. So when do you give the qualified opinion? As we know that type of modification depends on two factors. Two factors. Materiality and pervasiveness I am talking now. Materiality is there. Pervasiveness is not there. Then qualified. Materiality is there. Pervasiveness is also there. That means you saw the financial statement, materiality you found out, pervasiveness you did not find out. Then qualified. You saw the financial statement, you got the evidence, financial statements, and checking materiality is also there, pervasiveness is also there. Then adverse. You wanted to see the financial statements as an evidence. They are not giving evidence only, first of all. In that case, he concluded that okay, whatever the mistakes are there, that is material also may plus pervasiveness also. Then or this potential materiality and potential pervasiveness, then it is called as disclaimer of opinion. When you don't give an evidence for me to verify, then I don't give the report. That's it. Tit for tat. If you give the report or this evidence and I verified those things, then it is easy for us. Now that is for easy understanding. Now we will go for technical part. Qualified opinion. When do you give the qualified opinion? There are two situations. Two situations where the qualified opinion is expressed. First situation is where you obtained some evidence, sufficient and appropriate audit evidence. Based on that, you concluded that financial statements are materially misstated but not pervasively misstated. Then qualified opinion. Second category is you are not obtaining the financial statements. You are not getting the sufficient and appropriate audit evidence. But you are concluding then also material misstatement is there, but pervasive misstatement may not be there. Misstatements what could be there? That may be material but not pervasive. In that case, it is qualified opinion. So, auditors having obtained sufficient and appropriate audit evidence, this is important. Auditor concludes that misstatements either individually or in aggregate are material but not pervasive to the financial statements. Evidence based on evidence you are telling it is material but not pervasive. Second one is you are not able to obtain sufficient and appropriate audit evidence, but auditor concludes that possible effect. Why possible? Because it is future, we don't know it. Of undetected misstatements, if any, could be material but not pervasive. Under both the situations, whether you get the evidence, whether you don't get the evidence, only materiality should be there, pervasiveness should not be there. Then only it is qualified opinion. So what is adverse opinion? Adverse opinion is given by the auditor only when whatever the first point is there, na, the same thing here also there. But the difference here is in the first point you obtained audit evidence, sufficient and appropriate audit evidence, concluded MMS is there but pervasiveness is not there. In the adverse opinion, you obtained the sufficient and appropriate audit evidence, but you are concluding MMS is also there as well as pervasiveness is also there. Then it is adverse opinion. Sir, what is disclaimer of opinion? Whatever it is visible here, na, exactly same thing for the second definition of qualified, but here in the first part only materiality, no pervasive. Here materiality and pervasive. Possible materiality, possible pervasive. That is what a disclaimer of opinion. Disclaimer of opinion is not a type. Disclaimer of opinion is not expressing an opinion. Disclaimer of opinion. Adverse opinion. Qualified opinion. That means this is a type of opinion. Disclaimer of opinion. Opinion ne korta illa. That is a disclaimer of opinion. Having obtained sufficient and appropriate audit evidence, he concludes that material misstatements individually or in aggregate are both material and pervasive to the financial statements. Here auditor is unable to obtain sufficient and appropriate audit evidence to which on base his opinion and concludes that the possible effects of undetected misstatements, if any, could be both material and pervasive. Based on that, they tell that. This is what the summary of that matter, whatever we discussed above. You can go through that. Online people, you can take a screenshot. Then we left with two more points in 705. What is the basis for opinion section? How it looks whenever you change your opinion. The moment you change your opinion, consider in the 700 we discussed opinion and the basis for opinion. Now, if you are trying to give the qualified opinion, the opinion section only will happen to be qualified opinion. Here, basis for qualified opinion. If you want to give adverse opinion, it will be adverse opinion and the basis for adverse opinion. The heading itself changes. If they just tell that opinion and the basis for opinion, it simply means that unqualified opinion. See, there are two types of opinion, qualified opinion and unqualified opinion. Unqualified means MMS is not there, AFRFS is followed. That is unqualified. If MMS is there, that means material misstatements are there, pervasiveness is also there, everything AFRF is not followed, then modification happens. Modification happens depending on materiality and pervasiveness. Materiality and pervasiveness will decide qualified or adverse or disclaimer of opinion. Now, specific amounts are there with respect to material misstatement, then description and qualifications of the financial effects of the misstatements if practicable. If it is impracticable to quantify, state it in the report. That means you tell that in the description that this is what misstatement is there, try to quantify it. The misstatement could be 10 lakh rupees, 20 lakh rupees, quantify. And it, of the financial effects. If it is not practicable, then you just state that in the report there is a misstatement and there could be some financial impact. And MMS relating to narrative disclosures. Include an explanation and how disclosures are misstated. Again, MMS relating to non-disclosure of required information. You talk to the TCWG with respect to non-disclosure. Describe the nature of omitted information. If they should disclose ABCD, they did not disclose ABCD. Include the omitted disclosures in the report if permitted by law and regulation. And if you are not able to obtain sufficient and appropriate audit evidence, include the reason for such inability. Why? Because company is not allowing, company is putting the restriction, company not allowing me to enter the building, those things. So this is again a 5 marks question which we told it is important. Management, see, offered some engagement, I accepted the engagement. After I accepted the engagement, they imposed some limitations when after engagement is accepted. Then as an auditor, what you should do? There are stepwise procedures. First, the moment as an auditor you come to know about the limitations imposed by the management with respect to audit, first talk to the management. Sir, please remove that limitations. I want to do the audit. If they don't remove it, then talk to TCWG. Unless until all the TCWG people are involved in management. If they are only management, they are only TCWG, no need to go to TCWG because they are only same people, nasty people. Now, after that, you describe you talk to TCWG unless until everybody is involved. If they still not agree to do that, now you decide, try to understand what is the misstatement there. Is it material? Is it pervasiveness? If it is material misstatement, try to qualify your opinion, change the basis for opinion section and give the report. No sir, it is not material, not only material, it is even material and pervasive. Then as an auditor, try to what is this? Perform some alternative procedures. After alternative procedures also it is not possible, try to withdraw from engagement. If withdraw from engagement is also not possible, then give the disclaimer of opinion. Giving the disclaimer of opinion is always at the end of the part. So, limitation discovered after accepting the engagement. Then, if the auditor becomes aware that management has imposed the limitations on the scope of the audit, that is likely to result in a qualified or disclaimer of opinion, the auditor shall request the management to remove the limitation. If you remember, if you see here what we explained, we never touch the adverse opinion. Why? Because management is imposing limitations to get the evidence only. When we don't get the evidence, the adverse opinion will not come. Either second part of the qualified opinion definition or the disclaimer of opinion and unable to obtain the evidence. Then communicate matter at TCWG unless everybody is involved in managing entity. Then determine whether it is impossible to perform, possible to perform alternative procedures to obtain sufficient and appropriate audit evidence. Possible, do it. Then if not possible, but you conclude that it is materiality is there but not pervasive, then you qualify your opinion. No sir, still unable to obtain sufficient appropriate audit evidence, but you conclude materiality is also there, pervasiveness is also there. Then withdraw from the audit engagement. Actually, there should be one more thing. Perform alternate procedures, audit procedures. If that is not possible, try to withdraw from audit wherever it is practicable and possible to withdraw it. If not possible, then disclaim an opinion at the end. But if the auditor decides to withdraw, that means this point A of this part withdraw. Na? If you are appointed as a government company auditor, give the report for resignation to the C&AG, shareholders, ROC, everybody have to tell the reasons, whatever your findings are there. Before withdrawing, communicate to TCWG any matters regarding the misstatements identified during the audit that would have given rise to modification or opinion. That's it with respect to 705. Special points, you can go through that anyway. This is a summary part. Please take a screenshot of it. So we'll begin with SS701, key audit matter. So what is this key audit matter? While we are doing the audit, I felt these matters important whenever I am doing the audit, and I even communicated these matters to TCWG also. Please have a look into it. I am telling now you people also as a users of the financial statements, please have a look into it and make note of it. What is key audit matters? Matters in which auditor's professional judgment were of most significant in the audit of financial statements of the current period, selected from all the matters communicated with TCWG. So whatever you want to communicate in key audit matters, first the eligibility to communicate in key audit matters, that has to be first spoke to the TCWG. Then only you can put it as key audit matters. There is one more standard called as SS706. The main difference between 701 and 706 is emphasis of matter is, while I am doing the audit, I felt these are very important for my audit. That is 701. What is emphasis of matter paragraph? These are common for me, but I felt these things are important for your understanding to the users. That is what 706 is talking about. When we go there, we'll talk about it. So, key audit matters objective is to determine key audit matters and having formed an opinion on the financial statements and communicate those matters by describing them in the auditor's report section. It is applicable for all the listed entities compulsorily. Second, wherever the auditor decides to communicate key audit matter or wherever the law tells to communicate the key audit matter, then it is mandatory. Generally, it is law, or where the auditor feels it is necessary to communicate the key audit matters, he will communicate. Then, what is the purpose of key audit matters? What is the purpose of key audit matters? Why do I tell that is important? Because while you are reading, you will pay some extra attention to these matters so that you get some better clarity on the company. So it will enhance the communicative value of the auditor's report, and it will assist the intended users in understanding the areas of significant management judgment in the audited financial statements, because the auditor might also might mention those areas which are considered as significant and they are judgment based, and it will also provide additional information to the intended users. See, please have extra information in your hand. How do you determine key audit matters? Anything which I felt in my audit is having higher risk of material misstatement, higher assessed risk. I assessed it as higher risk of material misstatement, or there is a significant auditor's judgment relating to areas in the financial statements that involve significant management judgment. That means, if you remember, one of the inherent limitations of the audit, that nature of financial reporting is significant judgment of the management. That is why it is there. And effect of significant events or transactions that are occurring during that period, that is also considered. How do you communicate the key audit matter? So, key audit matter, if you look at the thing which we discussed in the 700, we told that title, address, opinion, basis or opinion, key audit matter section is separately there. Whenever auditor want to communicate key audit matter, auditor should use a appropriate subheading in a separate section of audit report, stating it as key audit matter. What is main heading? The audit report is main heading, under which subheadings, title, address, opinion, everything is subheadings. And it shall also state that whatever the matters were addressed here in the context of audit of financial statements as a whole, and in forming the auditor's opinion thereon. And the auditor does not provide any separate opinion on these matters. It is just given for your reading. I am not giving any opinion on these matters while I am giving my opinion. But there are some circumstances of non-communicating key audit matter or limitations of non-communicating key audit matter. That means whenever you want to communicate key audit matter, just because you tell key audit matter, it is not like other things are excluded. If you are supposed to report as per 570, definitely you should report as per 570. Just because you tell that, sir, I told it in key audit matter, I don't want to communicate 570, no, that is not acceptable. If you are required to modify your opinion based on pervasiveness and materiality, you definitely have to modify that. You can't tell that, sir, I told it and communicate to key audit matter. If you are required to tell that AFRF has been followed or not, you have to definitely disclose that, not telling that in a key audit matter. So, this is a 4 marks important question which tells that communicating key audit matter, communication of key audit matter is not a substitute for, it is not a substitute for what things? Disclosure in the financial statements, whatever the financial statements has to be disclosed, that has to be disclosed, and reporting as per 570 or modified opinion as per 5705. These are the 3 requirements, not a substitute for these things. But again, this key audit matter also not a separate opinion. My opinion is only one which is given above. It is not a separate opinion. I just told it for your key communicative value. Now, where key audit matters are not communicated, whenever the law or regulation precludes means excludes public disclosures in such matters, or if adverse consequences of communication would outweigh the public interest benefit. That means the moment you tell it key audit matters, whatever the benefit we get, more than that there is some adverse effect. Outweigh means what? Benefit ಗಿಂತ ಜಾಸ್ತಿ ಪ್ರಾಬ್ಲಮ್ ಆಗುತ್ತೆ ಅಂತ ಹೇಳಿ ಅನಿಸಿದಾಗ you should not communicate the key audit matter. Outweigh the key audit matter. So, communication with TCWG matters determined as key audit matter. That means auditor shall communicate matters determined in key audit matter to TCWG, and if no key audit matter is determined, the audit communicate the auditor's determination that there are no key audit matter at TCWG. That means if you have something to tell it in the key audit matter. If you don't have anything to tell, put the heading as key audit matter, tell that I don't have anything to tell it. Then whatever you do, that has to be compulsorily documented so that you can protect your interest in the future period of time. So, if key audit matter is determined, matters that are required significant attention for determination of key audit matter. If no key audit matter is determined, then there is no key audit matter. Key audit matter is not communicated, then auditor's reason for not communicating the key audit matter in the audit report also has to be stated here. This is what SS 701 key audit matter. Please have a look into it. We completed this standard in around 6 minutes. Now we will begin with 706 emphasis of matter paragraph and other matter paragraph, EOM and OM paragraphs. So what is this EOM and OM paragraphs? As I told in 705 video, whenever the auditor was doing the audit and he felt some matters as important not for his audit but to the understanding of the users of the financial statements, those matters has to be communicated in SS 706, that is emphasis of matter paragraph. Then other matter paragraph is talking about auditor want to communicate something which is not those things which are other than presented in the financial statements but which is related to financial matter, then auditor will tell it in the other matter paragraph. So mainly EOM paragraph, a paragraph includes in the auditor's report that refers to a matter appropriately presented or disclosed in the financial statements that in the auditor's judgment is of such importance that it is fundamental to the user's understanding of the financial statements, not for me. Again, what is OM paragraph? Other matter paragraph is a paragraph included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statements that in the auditor's judgment is relevant to users' understanding of the audit and the auditor's responsibilities or auditor's report. This is what other matter paragraph. Other than those presented or disclosed in the financial statements, but related to financial matters only. Sir, if there is anything which is required, auditor want to tell which is other than financial matter, other than financial statements, then where do you communicate? There is one more section called as other information paragraph. That we did not discuss here because that is not as per our syllabus. But that is also possible as per SS 720. That is not there for here. Other information. Then what is the objective of the auditor with respect to EOM and other matter paragraph? Having formed an opinion on the financial statements to draw the user's attention when in the auditor's judgment it is necessary, by way of a clear additional communication in the auditor's report, by way of an emphasis of matter paragraph, or by way of an other matter paragraph. When do you use other emphasis of matter paragraph? Whenever he wants to draw the user's attention to a matter important for understanding in the financial statements of the user's judgment, auditor's judgment, provided the matter is already not communicated in 701. If it is already communicated in 701, you let it be there, you don't put it here. Or where the auditor is not required to modify the opinion as per 705, because you modified your opinion because of this matter only, then don't put it as emphasis of matter paragraph, because that is the reason you put it in basis for opinion paragraph. Why you want to increase the audit report thing? Then with respect to OMP, other matter paragraph, the auditor shall include other matters paragraph in the auditor's report, provided this is not prohibited by law or regulation, or if it is told in 701, the matters has not been determined as key audit matters to be communicated in audit report. If it is already determined as per 701, go for that. If not, come for 706, other matter paragraph. How do you present it? Emphasis of matter paragraph and other matter paragraph. Separate section you put it, separate subsection, separating in the thing, and tell that this is what important for users understanding, etc. Manner of presentation of emphasis of matter paragraph. Include the paragraph within the separate section of the auditor's report with an appropriate heading that includes the EOM paragraph, emphasis of matter paragraph, and shall express the matter he shall express the matter being emphasized and give reference to such matter in the financial statements. This paragraph shall refer only to the information presented or disclosed in the financial statements. That means if it is not there in the financial statements, you can't put it in EOM paragraph. What is when the opinion is not modified? Auditor's opinion is not modified in respect of matters emphasized. There is separate section, that's it. It is not modification of opinion. However, it is not the substitute for same things which we discussed in 701. Same as SS 701. Not a substitute for modification as per 705, disclosure of FS or 570. As well as it is not a separate opinion also. How do you communicate with TCWG and circumstances for EOM paragraph? If the auditor expects to include EOM paragraph or other matter paragraph, you directly don't include in the audit report. First, auditor shall communicate with the TCWG regarding its expectation and wordings of the paragraph. Sir, I felt these are important for users understanding. I want to put it as EOM paragraph or other matter paragraph. You have any objection? First, you talk to the management or TCWG. After that, circumstances where EOM paragraphs is necessary. An uncertainty relating to the future outcomes of an exceptional litigation or regulatory action. If you feel this matter, for example, you are as an auditor, you are feeling there is already a case going in the court. I feel case is not decided yet, but I feel okay. If this goes out, that means against us, we might need to give 50% of the company only. I felt it is important for you to know it. Yes, I put it there. Or early application of new accounting standards that has been pervasive effect on the financial statements in the advance effective date. That means your Ind AS is not applicable for you, but you started in applicability of Ind AS from today only. It is applicable for you after 3 years. Then your everything entirely changes because of the accounting treatment. Pervasive effect is there. Then tell it as EOM paragraph. Or there is a major catastrophe that had occurred or continues to have a significant effect on the entity's financial position. You also have a look into these things. These are the matters when you will go for EOM and other matter paragraph 706. Have a look into it. SA 710, comparative information, corresponding figures and comparative financial statements. Comparative information is a broader category. Information consists of figures as well as financial statements. Figures is not what you think. Figures means numbers. So comparative information, corresponding figure and comparative financial statements. So what is the main difference between these things? Corresponding figures and comparative financial statements. So corresponding figures, if they are presented in the financial statements of the current period along with the current period, then whenever I express an opinion thereon, I express opinion only on current period financial statements. I just have them for reference purpose, just for comparison purpose, and I don't express my opinion on the corresponding figures separately. But whenever we come to the comparative financial statements as an auditor, whenever I express my opinion even includes separately for current year financial statements as well as comparative financial statement. This is the main difference between corresponding figures and comparative financial statements. For that, types of comparative information, that is comparative information are amounts and disclosures included in the financial statements in respect of one or more prior period in accordance with the AFRF. If you look at the Schedule 3 format balance sheet, they have like current year column as well as previous year column. So previous year column is given for just for comparison. What is the closing last year? Has it been correctly brought forward or not? To check all those things, they have given it. Two types of corresponding figures are there. Corresponding information is there. Comparative information. One is corresponding figures and comparative financial statements. Sir, what is corresponding figures? What is comparative FS? Amounts and disclosures for the prior period are included as an integral part of current period financial statement. They are not separate, they are part of current period financial statements only, and are intended to be read only in relation to the current period figures. You are not supposed to read it separately as separate financial statements. If you are reading current period financial statement, then only that has a value. If you are not reading it, then it has no value. So it is not referred to the auditor's opinion. You don't give any separate opinion on those things. But when you look at the comparative FS, amounts and disclosure for a period, prior period, are included for comparison with the financial statements of current period. Yes, but whenever you are giving your opinion, you should refer to it in the opinion if it is audited. You should express opinion separately on those comparative financial statements. What is the procedure with respect to those comparative information? Comparative information as per AFRF. I am not talking about corresponding figures or comparative financial statements. I am talking about the general category now. First, comparative comparative information. Auditor shall ensure that whatever the comparative information information given that agrees with amounts and disclosures presented in the prior period. If you give for comparison purpose, last year also you might have prepared one financial statements. These figures along with the current last year figures are there, everything should match. There should not be any discrepancy. Accounting policies are consistent with those applied in the current period. If you give the previous year financial state figures as or this comparison, then current year accounting policy and last year accounting policy has to be compulsorily same, consistent, unless until if there is any change and that change has been disclosed properly. Because one of the fundamental accounting assumption is what? Consistency. Consistency in accounting also. And if there is any changes, that has to be properly disclosed in the financial statements. Now, whenever you want to evaluate the material misstatement in the comparative information, if the auditor becomes aware of the material misstatement in comparative financial information, perform procedures to obtain sufficient and appropriate audit evidence. If the auditor has audited the prior period financial statements, then follow the requirements of 560, because you only audited last year, you only auditing the current year. Whatever the events occurred from last year to current year, which is not accounted in the last year, you treat it as subsequent events, SA 560, record as per that. And if you are not comfortable in anything, or you just want to still second factor authentication, go for written representation for all the periods, current year also, last year also. The auditor shall obtain specific written representation regarding prior period item that is separately disclosed in the current year's profit or loss. Now we are coming for comparative financial statements. So audit opinion shall refer to each period for which financial statements are presented and on which opinion is expressed. That means you tell auditor is audited 25, 26, 24, 25. Separately you have to refer it in the auditor's opinion. And opinion in the current period differs from prior period opinion. That means what is this happens? See, they are not talking about current period financial statements opinion and prior period opinions financial statements opinion. Prior period financial statements are audited by already audited. That auditor has expressed unmodified opinion, for example. Now I am keeping that as compared to financial statements in the current year. Now, whenever I am checking those financial statements of the last year, then I am feeling that it should not be unmodified, it should be modified, maybe qualified or adverse. That is what we are discussing. Opinion in the current period differs from prior period opinion. Not on the current period financial statements, but on the prior period financial statements. In that case, give us substantive reasons for difference in an other matter paragraph. You just tell it. How do you report it? With respect to corresponding figures. Audit opinion is not referred to corresponding figures except in case of below. Whenever the prior period report was modified, last year auditor was modified, and whatever the reason for which modifications happened, that reason still uncorrected. They did not correct only. Subject matter is still unresolved. Then you modify the current audit report also, tell it in the other matter paragraph that are basis for opinion because of the last year modification of these matters, I am modifying current year opinion also. Sir, why when there is a mistake in last year, why the hell you are modifying current year opinion? Just think, when there is a misstatement in last year closing stock, opening stock, maybe assets, liabilities, everything might be misstated. Whatever the last year closing was there, current year opening might have been there. That means last year misstatement is current year opening also misstated. Current year opening also misstated, current year depreciation also misstated, closing also misstated. That means everything is continuously the same. That is why you modify current year audit report also. If auditor obtains appropriate evidence, audit evidence of material misstatement in prior period financial statements on which unmodified opinion was issued. Already unmodified opinion was given, but while you are doing the current year audit, corresponding figures contain some material misstatement, you found it out. Then what you should do? You better express the qualified or adverse opinion on the current financial statements with respect to corresponding figures. If the material misstatement has not been dealt with as required by applicable financial reporting framework, that means the moment you find out some audit evidence with respect to material misstatement, talk to the company management TCWG. Sir, this is being happening. Tell it to your previous auditor. He has issued unmodified opinion, but actually should have issued some other modified opinion. If the other auditor does some audit and expresses the different opinion, don't do anything. Just ignore it. Just give a reference. If not, you modify your opinion either by qualified or adverse, and tell that because of these reasons I am modifying my opinion. Then last point is, there are two things. One is prior period financial statements are audited by predecessor auditor. Predecessor auditor means current year I am doing the audit, somebody else did the audit in the last year, or last year audit financial statements are unaudited only financial statements. That means I am the new guy to this company. In that case, if it is predecessor auditor done, then in the comparative financial statements, corresponding figures. Comparative financial statements, if the MMS exist in prior period financial statements, on which unmodified opinions were issued, then you should communicate to TCWG and request that predecessor auditor is informed. That means you tell the company that company will talk to the predecessor auditor. If it is permitted, state in the report, prior period financial statements are audited by predecessor auditor, type of opinion expressed, and date of audit report. 3 things you can tell. This is 3 marks question. What it is audited by somebody else, what report they expressed, and what is the date of report they did. With respect to corresponding figures, then same 3 things. Whatever the point B is there, same point B is there. If it is permitted, state in the report that prior period financial statements are audited by predecessor auditor, type of opinion, and date of audit report. But if it is unaudited, that means there is no comparison for you as whether they did it correctly or not. First of all, as an auditor, you should make sure that just because it is not audited, it will not relieve you from the duty to make sure that last year closing balances has been correctly brought forward in the current year or not. That you have to definitely make sure that. Include an other matter paragraph stating that comparative information is unaudited. However, auditor is not relieved from obtaining sufficient and appropriate audit evidence on opening balance. Opening balance has to be compulsorily there. Here also same. It is unaudited, sufficient appropriate audit on opening balance has to be there. That is 710. Please have a look into this key exam tip also. For all the question and answers, we will be making one more video for all the standards related part. You can refer that video, which will be given in the description box. Thank you. You see, in the elements of audit report, we discussed title, address, opinion, basis for opinion, This is again going concern we have to discuss. 701 is done. Responsibilities, auditor's responsibility, other reporting responsibility has to be done, and signature also discussed. Everything is already discussed, except that we should discuss this going concern as well as other reporting responsibility to complete this entirely reporting part. So now we will begin with 570. So what is this 570? 570 is talking about going concern of the company. See, whenever it is one of the fundamental accounting assumption that every company, whenever it is preparing the financial statement, they have to prepare it as going concern basis, accrual basis, and consistently. So what is this going concern? SA 570 is trying to tell that as a company I'm talking, not as an auditor, as a company, first you analyze yourself. Are you a going concern? Are you not a going concern? If you are telling that you are a going concern, what is the base to tell that you are a going concern? Sir, because we have sufficient cash, we have sufficient manpower, all those things are there, because of which we still feel we are going concern. We are not a closing down or liquidating company. So here 570 mainly talks about it is a responsibility of the management to decide whether you are a going concern or not based on some assumptions, based on which the auditor has to go and check whether whatever the assumption made by the management is correct or not. That is 570 is going to discuss going concern. What's the page number? Tell it. So it is a responsibility. So whose responsibility it is? It is a management responsibility for what? Assessing the entity's ability to continue as going concern. Even if the financial reporting framework does not include an explicit requirement, even none of the Companies Act, nothing is being telling anything. Even then also, you try to assess yourself whether you are a going concern or not. This assessment involves judgment about the uncertain future outcomes or events or conditions, because we don't know what is going to come in tomorrow. We just have to make some or this normal assumption. What is the auditor's responsibility here? Auditor's responsibilities. He should obtain sufficient and appropriate audit evidence for management's use of going concern assumption, whether they did it or not, and conclude whether any material uncertainty exists about the entity's ability to continue as going concern. After that, these responsibilities exist even if FRS does not require management to make going concern assessment. So, absence of reference to material uncertainty in report is not a guarantee of going concern. So, what is the procedure? As an auditor, you should first assess the risk. You check if the management has assessed that going concern assessment or not in the current year for next 12 months. Determine whether management has already performed a going concern assessment or not. If they have performed, assessed, discuss the assessment with the management and how management plans to address any identified events or conditions in the financial statements. Okay, sir, you told you assessed, you felt some 4 or 5 events are there which is affecting the going concern. How are you going to deal with it? Tell me. Sir, we will give it in the notes to accounts, significant notes to accounts. Yes, you can give it. Or if the management is not yet assessed, then discuss with management for basis. What is the basis for use of going concern assumption and whether any events or conditions exist with respect to things which are affecting the going concern. Sir, is there anything like any case is pending that if that case turns against the company that your company will shut down? You please tell me. Yes, discussion part. Then as an auditor, you should even evaluate the management's assessment. whatever they tell are that these things, you should evaluate the management assessment also. See, it is not the responsibility of the auditor to rectify lack of analysis by management. Lack of assessment by management may not prevent the auditor from concluding whether the use of going concern is appropriate or not. May not conclude. May not prevent the auditor from concluding. Management thought that, sir, actually we are not going concern. How management is thinking, I'm talking from management point of view. If I do the assessment now, I have to tell the auditor that I'm not a going concern. It is better that I don't do assessment only. It does not mean that auditor will believe that they are going concern. Auditor will use his mind, try to find out whether they are going concern or not. That is his duty, he will do it, whether you do it or not. Again, you should evaluate management's plan for future actions and whether they are feasible or not. Sir, what basis you are telling you are going concern? Sir, because I feel I am going to get some 100 crore rupees worth of orders in the next year, next 6 months, because of which I feel I am still going concern for 12 months. Are they feasible? That means, is it really possible? Yes, sir, we did it many times. This is a regular business. Yes, then it is okay for me, no problem. Again, you should evaluate even the process of management used to make assessment and assumptions on which it is based. What is the assumption they made? What is the assessment they made? But if the management, this is an MCQ point or 4 marks question also, if the management made an assessment covering for less than 12 months from the date of financial statements, then see, if you are completing, now we completed 25-26, now we are in April 3rd, now we come to the audit. Now, sir, when I say going concern, it is not 12 months before 2025-26. It is 12 months from 25-26, 31st March 2026. Allinda 12 months complete ಮಾಡಬೇಕು. ಯಾಕಂದ್ರೆ going concern is a future aspect. It is not a past aspect. From 31st March 26 till 31st March 27. Are you a going concern? Yes? Sir, yes, sir, but not up to 31st March, up to January 1st only. Only 9 months they made. No. Auditor has to request the management to extend its assessment for at least 12 months. If they are not doing for 12 months. Then whenever you find out some events or conditions, then what is your audit procedures? What is your audit procedure? So, where management has not yet performed an assessment, request the management to carry out one. Again, you should evaluate management plans for future actions and assess whether they are feasible or not. Where the entity has prepared the cash flow forecast. Cash flow forecast means what? They are going to get this much of cash is going to go out of the company, only cash flow related part. Evaluate reliability of underlying data. On what data you are preparing? Sir, because of the last 10 years I am taking, this is what it is happening from the last 10 years. Okay, that is acceptable. Determine whether these are adequate, there is adequate support to the assumptions used. Sir, what is there? Sir, you are telling 10 years. Is there any support? Yes, sir, you can look at the last 10 years cash flow and last 10 years actual financial statement. That is being matched almost. 99% is being matched. Okay, then also I'm okay. Again, if you feel necessary, consider whether any additional information has been available since the date when management is made assessment. Then, if you don't feel like believing them, then better go for written representation from management at ECWG regarding their plans for future actions and related matters. They are telling so XYZ they want to do. I doubt that this nonsense people will do it or not. So better to get it in written format so that you can protect your interest at least in the future time. Now, there are some events or conditions that may cast doubt on going concern. There are 3 types of events. One is financial events, second one is operating events, and third one is other events, other legal regulatory requirements. What is financial things? See, anything can be asked for 5 marks. This one or this one or this one. Financial events are like net liability or net current liability position. What is net liability or net current liability? Your assets are less than your liabilities. That is what net current liability. Or fixed term borrowings are approaching the maturity date. That means you borrowed 10 years deposit, 3 years deposit, 3 years back. Now within 1 month you have to redeem, but people don't want to renew the anything. don't want to renew, they want to take the cash, but there is no option that you are going to give the cash. Inability to comply with loan terms. Loan terms means, you remember the Byju's example I told. If you don't file the financial statements properly on a yearly basis with the regulators, then we will make that $1 billion as payable immediately on demand. That thing, if you comply with all the loans. Indications of withdrawal of financial support by creditors. Earlier, creditors are giving on a credit basis. Now, creditors are giving on a cash basis. If you give the cash, you will get the goods. If not, no goods. Inability to pay creditors undue debt. You took 3 months credit, but you didn't pay after 3 years also. Inability to obtain financing for essential investments. Negative operating cash flow. In cash flow statement, operating, finance, investing, three are there. So investing and financing is okay. That can be negative. That is acceptable. But operating in negative, that is not good for the company. Adverse key financial ratios. What is adverse key financial ratio? Debt equity ratio should be 2:1. So it is 10:1. That is very adverse. Adverse means negative. With respect to operating, management's intention to liquidate the or cease the operation. They only want to close the company. Or loss of key management personnel without any replacement. Or labor difficulties are there. Or shortage of important supplies. Loss of major market. Or key customer. Franchisee. Or license. Or principal supplier. Or there is a highly successful competitor which has been emerged. These are some operating indicators. Financial means related to money. Operating means related to business buying and selling and operational related part. And other things are company law. Government has changed the law regulations, which will definitely affect adversely to the entity. Now for ITC tobacco company, government is trying to ban, not for ITC, for everything. ITC government is trying to ban tobacco and tobacco related products in the whole of India. That means ITC is being affected negatively too much. Non-compliance with regulatory requirements, you should comply with GST ITR, not doing that. Pending legal proceedings likely to result in claims of the entity. Cannot satisfy, or uninsured or underinsured catastrophes. There are multiple things which will definitely cause an what is this? Doubt on entity's ability to going concern. Now, whenever you find out some events or conditions with respect and material uncertainty, financial statements must adequately disclose events or conditions, and management plans to deal with them. How are they to deal with? Clearly, they tell that material uncertainty exists in the financial statements. And disclosures include management's evaluation of significant judgment by management, magnitude means size, and likelihood and timing of the potential impact. Sir, how do you come to know some going concern is being affected? For example, sometimes significant delay in approval of the financial statements, or they are not giving the information, they are not giving the financial statements to auditor only. Some things are there. You can go through that. There is no problem with that. This is the last part, audit report part. Whenever you find out some going concern assumption is inappropriate, then in the financial statements, adequate disclosure of material uncertainty is correctly made in the financial statements. That means there is something misstatement, and in the financial statements, notes to accounts only, they are told that there is some misstatement in the financial statements. Adequate disclosures are made. Then don't change your opinion, give the unmodified opinion. But only thing which you have to do is include a separate section called as SF570 going concern, and in that going concern section you mention that extra because of these things entity might affect going concern. These things you have to write it. So audit report should state that express an unmodified opinion, but include a separate section headed material uncertainty related to going concern. Again, you draw the attention to the notes to the financial statements disclosing such matter. That means in the going concern, tell that for additional information, read note number 10, 20, 30, 40. State that these events indicate a material uncertainty exists, and the opinion is not modified in respect of that matter. Because they told, as an auditor, my duty is what? Postman. take it whatever is available, bring it to the people's plate. If they told everything correctly, then I don't have any problem. Adequate disclosures of material uncertainty is not made in financial statements. Second part. Then express qualified or adverse opinion. Why not a disclaimer of opinion? That means you found out some misstatement and you know that they did not disclose in the financial statements. That means you have an evidence that then it is qualified or adverse. In the basis of qualified or adverse opinion section, state that material uncertainty exists and that the financial statements do not adequately disclose that matter. If the management is unwilling to make its assessment, then directly go for disclaimer of opinion or qualified opinion based on the materiality and pervasiveness of the financial statements misstatements. This is for 570. Please have a look into it. Please take a screenshot of this. So essay 299, the name itself says that joint audit of financial statements. If you look at 299, 99 is together. That is why auditor and auditor are also together. Joint audit of financial statements 299. So what is joint audit of financial statements? When the audit of holding company is audited by somebody, subsidiary company is done by somebody, that is not called as joint audit of financial statements. When the same financial statements only audited by more than one auditor, that is called as joint audit of financial statements. Same period, same financial statements by more than one auditor. So appointing two or more individuals or firms to pool the resources and expertise to render an expert audit job in the given time period, that may be difficult to accomplish individually. If it is given for a single party, it is difficult to have done. That is why they might have appointed one or the other person, more than one person. So that is called as joint audit. Joint audit basically implies pulling everything put together, because one firm may be good in income tax, one firm may be good in GST, one firm may be good in ESI, PF. So multiple things are there, because of which pulling together all the resources is called as joint audit of financial statements. Why? Because expertise being shared within given time only, that is being completed. But only one difficulty here is you should share the fees. That is the biggest problem for all the auditors. So I said 299 objectives are to give the principle for joint auditor in conducting the joint audit, to provide an uniform approach to the process of joint audit, because when there is a joint audit, which auditor should be joining, what type of report they should give, everything for the purpose of maintaining consistency, this 299 helps. To identify and distinct areas of work and coverage thereof by each joint auditor, to identify individual responsibility and joint responsibility of joint auditors in relation to audit. So even though more than one auditor is there, what is your work, what is my work, that segregation is also being done by 299 covered here. But there are some advantages and disadvantages of joint audit. You go through that. Advantages are there is some sharing of expertise. If you have some problem or some doubt, you can consult the other party. Lesser workload for the audit team. Better quality of performance when you are given less work for more time. And you can give better service to the client also, and healthy competition can be encouraged. That is not going to happen in reality. But there are some disadvantages also. First disadvantage is you should share the fees. Psychological problem. You just started 2 years back. I am already 20 years in field. What the hell you are going to tell me? The psychological problems will be there. So again, general superiority complexes, problem of coordination of work, areas of common concern being neglected, uncertainty about the liability for work done. You just go through those things. There is nothing. Now comes, this is important for 5 marks. Mainly specifically, this is important. In some, whenever there are multiple auditors for the audit of financial statements, there are some individual responsibility also, there are some joint and several responsibility also. That means if one auditor is appointed for P&L, one auditor is appointed for balance sheet, one auditor is appointed for cash flow, then all the auditors are responsible for their part of the work. We call it as individual responsibility. But there are some areas for which all the auditors are compulsorily responsible. So what are those? We'll discuss. That is what important. So in respect of the work divided among the joint auditors, each joint auditor shall be responsible only for the work allocated to such joint auditor. If I take some work, I am allowed responsible only for that work. You don't ask me anything else, including the proper execution of the audit procedures. You can do every standards required, then you get the thing. But there are some areas where joint responsibility is there, joint and severally responsible. That is, if there are any areas which is not divided or carried out by all the joint auditors, audit work which is not divided and carried out by all the joint auditors, it is not divided, because of which everybody is responsible, or everybody carried out that work, that is also everybody is responsible. Decision taken by all the joint auditors in respect of the common audit areas, with respect to planning, with respect to execution, programming, then everybody is responsible for that. Matters brought to the notice of auditor by any one of them and on which all of them agree. For example, I bought one motor for other two partners. Yes, they also said yes. They also started doing the same thing only. The moment they agree, that is the responsibility is there. Examining compliance with financial statements and statutes. You can't tell that, sir, I am dealing only with the P&L disclosure part. Now you can't tell that, sir, whether the schedule 3 is correctly followed or not, I am not going to take care. No, that is your primary responsibility. You can't divide the applicability and compliance of the financial statements along with the relevant statutes. Presentation and disclosure of financial statements as per AFRF, that also has to be there. Ensuring compliance with relevant statutes, applicable essays, and other relevant pronouncements. Pronouncement means it is like one bare act kind of thing. Pronouncement is given by ICI. These are the areas where everybody is responsible. One is audit work is not divided, where work is done by everybody. Decision taken by all the joint auditors, or matter brought into the notice of all the auditors and decision taken by everybody. And with respect to whether compliance of the financial statements are there or not, with respect to Schedule 3 accounting standards, then everybody is responsible. Presentation and disclosure as per AFRF, that is also everybody's responsibility. And lastly, compliance with relevant statutes or etc., that has to be checked. 5 marks question, important. Then some communication, planning and reporting, 3 concepts are remaining. Sir, what is communication with TCWG? Whenever joint auditors expect to modify the opinion or include an EOM or other matter paragraph, they shall communicate with the TCWG regarding the circumstances and proposed wordings of the report. See, in 701 also, 706 also, we told that whenever you want to touch the key audit matter or another matter, first talk to the management. Sir, I want to put some key audit matter or EOM matter. Is it okay for you? If you have any problem, please let me know. That is what you have to tell. Again, one more thing. Before this thing, I think one or two lines is missing here. That is, every joint, whenever the company appoints a joint auditor, company should give common engagement letter for everybody. That is there in the main material. Here it is, I think, missing, or it is there somewhere else. Common engagement letter should be given for every auditor, like in a separate copy. But when it comes to reporting part, all the auditors are not required to give the same report. If they disagree with what other partners are telling, then that's okay. You can give your own report. I will give my own report. But one problem, one requirement here is, whenever you are giving your report, you give the reference of other report in your report. And the other party also has to do that. Yes, there is one more report given by one X auditor, Y auditor, giving modified or unmodified opinion. Please take care of it. Audit planning, risk assessment and allocation of work. Engagement partner and other key members from each one of the joint auditors shall be involved in planning stage. Everybody be part of the planning stage. Only you can tell that, okay, you plan and give me the plan. The joint auditor shall establish an overall audit strategy. Joint auditor shall discuss and develop a joint audit plan. This is for planning phase, because it is a joint audit. ROMM is considered and assessed by each joint auditor and communicated to other joint auditors and documented whether pertaining to overall FS or an area of allocation. Doesn't matter, whenever you do some risk of material misstatement with respect to any joint audit, that has to be given. The joint auditor shall discuss and document nature, timing and extent of audit procedures and communicate the same to TCWG. Communicate the same to TCWG. The joint auditor shall obtain a common engagement letter and common management representation letter. It is given here, common engagement and common management representation letter. The work allocation document shall be signed by all joint auditors and communicated to TCWG. Whatever you do the audit working paper, that has to be signed by everybody and communicated to TCWG. Last thing is reporting and conclusions. Joint auditors generally issue a common audit report, but in case of any disagreement, they shall express their opinion in a separate audit report. So just because majority of the people is telling yes, it is not that you are also going by yes only. Auditor is not bound by the majority of the opinion. The audit report issued by joint auditor shall refers to a separate audit reports issued by other joint auditors. That means cross reference. Such reference shall be made in the other matter paragraph. Other matter paragraph will tell that there is one more, two more, three more audit reports. Please have a look into them also. Each joint auditor shall assume that other joint auditors carried out work as per the standards. That means no need to go and check that whether they done it correctly or not, because they are also responsible for their work individually. They are also chartered accountants. Ethics are also available for them, applicable. Other joint auditors have informed the said joint auditor about any departure from the applicable FRM. Then before finalizing their audit report, the joint auditor shall discuss and communicate with each and other respective conclusions from to form part of content of audit report. If everybody is okay, give the same report. If not okay, you give the separate report. Sir, how do we come to know everybody is okay or not? First sit and discuss with respect to every auditing report part. That is for 299, 299 standards on auditing. I look into exam tips. Now we'll begin with CARO 2020. So it is, see, along with these standards, we are discussing auditing subject. I know that there are some standards which every auditor has to follow that. Along with the standards which are given by ICI, which are required to be followed, the auditor, in some cases, also required to follow some Companies Act related provisions. Mainly section 143 related provisions. Under 143, the main applicability for the company is 143.1, 143.3 and 143.11, as well as 143.12 is also there. So what is 143.1, 143.3 and 143.11 and 12? 143.11 is this CARO only. 143.12 is mainly talking about reporting of fraud, which we discussed in our Companies Act also, corporate law subject. Here also we will discuss it a bit later. If you remember that more than 1 crore rupees of fraud in intimation to the central government, 2 days, 45 days, 15 days in letterhead everything, but less than 1 crore rupees fraud, tell it to the company in 2 days, 3 things, nature of fraud, amount of fraud, what is the type of parties involved, again that way they will give it in board report format. That 143.12 we will discuss later. 143.1 and 143.3, two specific things are there. First one is duty to inquire. First one is duty to inquire, 143.1. 143.3 is talking about duty to report. Now 143.1, 143.3, 143.12 we'll discuss it a bit later. First now we'll focus on very important 5 marks examination question, that is CARO 2020. 5 marks will definitely come, 5 or 6 marks in the CARO part. So this CARO 2020, if I try to be putting here, this CARO consisting of, which is given under 143.11 of Companies Act, consisting of 4 paragraphs. 4 paragraphs. Para 1, para 2, para 3 and para 4. Now we are mainly concerned about para 2 and 3. Para 1 is talking about commencement, all those things are given there. Para 2 is talking about applicability of the CARO. Para 3 is talking about what matters is being spoken by CARO, 21 matters are there. And para 4 is talking about whenever you tell in para 3, consider PP is there, first clause, you tell PP is not maintained, that is not there, this is not there. What is the reason why you objected it? What is the reason why you corrected it? That reasons for favorable or unfavorable opinion has to be given under paragraph 4. Now when I tell paragraph 2, it is consisting of applicability. Applicability. Sir, what applicability? This CARO is applicable for what entities? It is not applicable for what entities? The CARO is applicable for all the entities, all the companies, all the companies, all the companies, including foreign company, but but excluding few companies. Sir, what is that exclusion? First exclusion is small company. For them, it is not applicable. OPC, it is also not applicable. Banking company, insurance company, then Section 8 company. Then last one is private company with some conditions. If you are a private company which is fulfilling or which is having any of three conditions, right? Paid up share capital, outstanding borrowings as well as turnover. If your PUC is less than or equal to 1 CR, then it is not applicable. You tell me, is it equals to applicable or not? Not more than 1 CR. That means equals to is also there. Are outstanding borrowings less than or equal to 1 CR only? Or turnover is less than or equal to 10 CR. You tell me, outstanding borrowing is less than or equal to or only less than? Not more than. Same. Not more than means not more than 1 crore. Okay, 1 crore and 1 rupee is more than that. So if you are under these conditions, for you also CARO is not applicable. This applicability itself is a 5 marks question. Many times they tested it. You should go like CARO 2020 is applicable for all the companies including the foreign company. However, excluding small company, OPC, Section 8 company, insurance company, banking company and private company which is having a for which paid up share capital does not exceed 1 CR or does not exceed only, right? Not more than 1 CR, or outstanding borrowing is not more than 1 CR and turnover is not more than 10 CR. Then CARO is not applicable for you. Now comes paragraph 3, which is very important. We have 21 clauses. Specifically, we have 21 matters to be reported to the users of the financial statements. Sir, what 21 matters we have to report it? Under 21 matters, there are some details also. So, as an auditor, see, whenever auditor is being appointed, yes, auditor has to give the audit report. There is no substitute for that audit report. You should modify, not modify, do whatever you want. But along with the audit report you are giving, if you find out anything for certain companies except the above things, you should even give CARO 2020 also. Normal audit report and CARO 2020 report. That CARO 2020 report consisting of 21 clauses, which goes with first one, clause number 1, which is important also. Clause number 1 important. Mainly talking about fixed assets or property, plant and equipment. As an auditor, you should inquire about 5 matters in a CARO. You should report about 5 matters in the CARO. Sir, what are those 5 matters with respect to property, plant and equipment and intangible assets, both fixed assets and intangible assets? First one is, you should check whether company maintains proper records showing two things, showing quantitative details as well as location of PPE and intangible assets. Sir, what is quantitative details? Number of property, plant and documents, 1 car, 2 car, 3 car, and location. They are in this office, other office, Bangalore, Karnataka, everywhere it has to be shown. Property, plant and equipment, whether company maintains a record with respect to physical register, with respect to quantitative details and location of PPE as well as intangible assets. That is the first subclass of PPE. Second one is, If they are maintaining that, that's okay. Second one is whether company is doing physical verification. Management is doing physical verification at the reasonable intervals or not. Whenever they are doing physical verification, if they find any discrepancies, how they are dealt in books of accounts, that also has to be checked. Sir, what is reasonable interval? It depends on entity to entity. If the entity is too big like Reliance, Tata Motors or those things, then even 3 years once is also okay. If the entity is mid-size or lower size entity, then 1 year once is sufficient. That is what? Second one. Third one is title deeds of immovable properties are held in the name of company or not. That has to be checked. What is title deeds? Ownership documents of the immovable properties. If the land, building, all those things, if it is held in the name of company, if not held in the name of company, you should give the reasons regarding it is held in the name of which party, for what is the nature of asset, for how long, what is the relationship, all those things has to be given. Then whether PP or intangible assets have been revalued during the current year. If it is yes, then is it done by revalue registered valuer or not? That has to be checked. Here one small point you should add it out is if there is any change of 10%, then that also has to be what is treated in financial statements or books of account. Last one is, are there any things at any time did you hold any Benami property where government came and initiated, or are there any pending actions with respect to any items or holdings of Benami property? If yes, you delete in the books of accounts properly. This is clause 1. Clause 1 is talking about 5 elements. The first element is whether physical, not physical, register, physical assets register is being maintained by the company with respect to location, situation of PP and intangible assets. Second one is physical verification has been done at the reasonable intervals. If there is any material discrepancy, that also has to be dealt. Third one, immovable properties, title deeds are there in the name of company. If not, reason and it is held in the name of which party. Fourth one is if there is any revaluation done in the current year and there is a change of 10% or more, then that also has to be dealt in books of accounts. Fifth one is if there is any Benami property that is disclosed or surrendered by the company or found out by any authority, that also has to be disclosed in the financial side. How they are being dealt in the books of account, that also has to be seen. That is PPE and intangible assets. Then comes inventory. This is also important. They might many times ask it. Specifically, the second part they ask. Whenever this is inventory, auditor also has to check that whether company is maintaining the physical register or not. Along with that, physical verification, physical assets, physical inventory verification register has to be maintained. First point. The second sub point is physical verification of inventory has to be conducted on a reasonable interval basis. If there is any change of 10% or more, that also has to be dealt in proper books of account. 10% discrepancy. Then second one is, as a company, have you obtained any working capital loan from any bank? Yes, sir. Sir, have you obtained more than 5 crore rupees of working capital loan? Yes, sir. In that case, you should file quarterly returns for the banks stating the quantity details of the inventory which was lying in the in a warehouse. Now, as an auditor, whatever returns filed with the bank, are they matching with the books of accounts or not? That I have to check. Because for the purpose of getting higher loan amount, they will prepare some documents with the overstated figures. That should not be done. So that is called as inventory. First one is physical register and physical verification. Change of 10% has to be correct. Register dealt in books of accounts. Second part is working capital loan of more than 5 crore rupees. Exceeding 5 crore, not even 5 crore, exceeding 5 crore. Then quarterly statements has to be filed with banks, institutions, financial institutions, and they are agreeing with the books of accounts or not, that has to be checked. Then clause 3. This is also important. They can ask from anywhere. This is big, lengthier standard. That's the clause. First one is whether in the current year company made any, I call it as LGSI directly, loans, guarantee, security, and investment to the company's firms or other parties. To the company's firms or other parties. If yes, provided, then report the following part. What they have to report? What they have to report? They have to report aggregate amount. It is amount during the year. What is the balance outstanding at the end of year to the subsidiaries, joint ventures, and associates. We call it as related parties. What is the loan you made in the current year? What is the outstanding money at the end of year during the to the related parties? Same things for the outstanding to the other parties. That is other than related. Other than related. After that, you should even check whenever you made that LGSI, whatever the terms you there, are those terms not prejudicial to the company interest or not? That also has to be checked. First one is what? Company made any LGSI to any company, subsidiary, LLP, etc. If yes, then how much you made in the current year? How much is outstanding in the current year? To the related parties. Same thing for the other than related parties. You don't write the word related parties, write the word subsidiary, associate, joint venture. So then you have to check it. Then third point they have to see here is whatever the terms you are there with the parties are they prejudicial to the interest of the company or not? That also has to be checked. Then fourth one, whether the repayment schedule of principal interest is stipulated and repayments are regular or not. Stipulated means given or not. That also has to be checked. Repayments with respect to those things. If there is any overdue, report the amount of overdue for more than 90 days and steps taken for recovery. How they are recovering. Then whether the loans falling due in the current year were renewed or extended or settled through a fresh loan, and report the aggregate amount and percentage of total loans granted. That means somebody else is supposed to pay you the money in the current year. They don't have the money. You only give one extra loan or you extended the period. Then that also has to be disclosed here. Then whether the loans are repayable on demand or without any repayment terms, including the aggregate amount, percentage of total loans to promoters or related parties, that also has to be disclosed here. What is this? No time period given. It is either repayable on demand or without specifying any terms of repayment. There are how many points? 7 points are there. What are those 7 points? Have you made any LGSI to any parties? If yes, total made outstanding in the current year at the year end. Again to the other parties and related parties. Two things are there. Then third one is terms and conditions are not prejudicial to the interest of the company. Fourth one, repayment stipulation of repayment of principal and interest is given and repayments are regular or not. Fifth one, is there any overdue for more than 90 days? Then that also has to be given. Sixth one, if you have granted any loan or extended any period fresh loans for a settlement of old loans. Seventh one is for loans without specifying any terms or repayable on demand. That also has to be checked. 7 points has to be checked in third clause. Now fourth clause they're talking about whenever you do that LGSI, comply with 185, 186. That's it. Nothing to be discussed in that thing. Now public deposits. Clause number 5 is public deposits. Whenever company is accepting the public deposits as per chapter 5 of Companies Act, deposits chapter, mainly public are not from members. You should comply with section 73 to 76 of Companies Act 2013. Again, you should comply with RBI directives regarding the deposits. Again, if there is any order by Company Law Board, National Company Law Tribunal, RBI Court, that also has to be complied with. Three things has to be seen under clause 5 of deposits, the public deposits. One is 73 to 76 of Companies Act. Then RBI directives. Third one is company law or tribunals or courts order has to be complied. Then sixth one, simply if you are required to maintain the cost records, follow 148.1. Seventh one is there are two types of dues. One is disputed statutory dues, undisputed statutory dues. What is undisputed statutory dues? Undisputed means what? You only filed income tax return or GST return, you are supposed to pay 10 crore rupees as tax. Now department also accepted 10 crore rupees. That means by what time you should pay it? When I say statutory dues, not only income tax or GST, it can be PF also, it can be ESI also, it can be gratuity, anything can be there which is supposed to be paid as per law. Then that also has to be paid within whether a company regularly in depositing undisputed statutory dues such as GST, PF, ET, etc. and report any arrears outstanding for more than 6 months. If there is anything more than 6 months, you report it. From where? From due date. Then if it is disputed dues, now you should report two things as an auditor. So you should check whether two things are reported or not. One is what is the amount involved in the dispute, in which form in which forum the dispute is pending. Income tax, ITAT, GST, High Court, Supreme Court, where is it pending? That also has to be given. Only two things as per disputed statutory dues. Then eighth one, unrecorded income. What is unrecorded income? Like black money. If you have created any black money which is surrendered, given anywhere, then you should deal it in the books of accounts properly in the current year. Then clause number 9, that is also important. Clause 7 is also important. Clause 9 is also important. Other 1, 2, 3, 5, 7. Not 5. 5 is okay. 7 and 9. Repayment of borrowing. Repayment of borrowing. First one we have to check is whether the company has defaulted in repayment of loans or interest, stating the amount and period. You have to check whether the company has declared willful defaulter by any lender. If they have declared willful defaulter, there are some extra details you should give the lender wise details. The lender wise details. What details you have to give? Tell me. What is the the lender and facility wise has to be given. That one table is there. Nature of borrowing. Name of the lender, amount borrowed, principal or interest. Then any remarks? There is one more point. Yes. Number of days delay, that also has to be given. Those extra details has to be checked. They asked one specific question on this only for 4 marks. The details writing. When there is any willful defaulter, that also has to be given separately by facility wise and lender wise. Again, whenever you borrowed some term loans, did you use it for anything other than borrowed purpose? Diversion have you done? If yes, give the details. Whether short term funds are used for long term purposes, give the details. See, give the details means auditor will check and write it in Caro report. That also has to be there in financial statements already. And again, whether the funds taken to meet the obligation of subsidiary, associates or joint venture, with the details you have to give. That means subsidiary company went to borrow the loan, bank told please get out. Then you went to the bank and borrowed the money and gave the money to subsidiary. That means for subsidiary purpose you borrowed the money. Then give the details here. Now whether are the loans were raised by pledging the security subsidiary JV associate, and whether there were any default or not. That means when you are holding more than 50%, that is an asset for you. That asset you kept it as mortgage or any pledge or hypothecation somewhere and borrowed the money. If yes, give the details. Which company securities you kept it. That is 9. Then comes 10th one. 10th consists of mainly 5 elements. Application of funds raised. Whenever you raise funds for some purpose, you should use the funds for same purpose. Sir, what is the raising of funds purpose? There are 5 purposes, 5 modes of raising. One is issue of equity shares, IPO, FPO. Then second one is, the next one is conversion of debentures or preference into equity shares. Then stock into shares, shares into stock, private placement and preferential allotment. These are the 5 things which are there. If you raise any money for that purpose, you use it for the same purpose. That is given under clause 10. Then clause 11, whenever you find out any fraud in a company, on the company, it is on the company, not by the company. Sorry, it is on the company as well as by the company. But in case of 143.12, that is only on the company, not by the company. Here it is on the company and by the company. Then you should tell that the nature as well as amount. Report as per 143.12 also, that means central government more than 1 crore rupees. And you should even consider whistleblower complaints in while you are doing the reporting the fraud. Then comes Nidhi company, clause 11, 12. There are 3 things which we have to check as a Nidhi company. Whether the net owned funds to deposit ratio 1:20 maintained or not. That also has to be checked. That means if you want to raise 20 rupees deposit, you should put your own money as 1 rupee. Then we call it as whether net owned funds to deposit ratio is there or not. Second, out of the term deposits, whatever it is accepted, 10% should be in unencumbered deposits. Unencumbered means what? Not mortgaged or pledged for something. It is free from any charge. Free from charge. Free from charge. Whether there was any default in repayment of deposits or interest, that also has to be checked as an any company. 1:20 net owned funds to deposit ratio. Then 10% of unencumbered time deposits has to be kept. Any default in repayment of loan or interest or deposits, both has to be checked. Then 13 is nothing. Related party transactions are there now. 177 and 188 you complied. Then internal audit also nothing. Every company should have, wherever the company, you remember section 138 of Companies Act, public company, listed company, private company, they should appoint based on that 4 conditions or 2 conditions. If it is applicable, then you should have internal audit system which is commensurate, that means matching with the size and nature of business. Then whether internal reports were considered by the statutory auditor or not, whatever the report given by internal external auditor. Then 15th one, non-cash transactions with the directors comply with section 192. Then 16th one is RBI, registration with RBI. There are 4 points here. As a NBFC, are you required to get license or registration under 45 IA of RBI Act? If yes, did you obtain the registration? Whether the company conducted NBFC or housing finance activity without RBI's certificate of registration, then that is not good. You should not do it. Again, whether a company is a core investment company and satisfies CIC criteria. You remember what is CIC core investment? You invest 90% directly in one group of companies like Tata Steel, Tata Motors, Tata Salt, Tata Titan, etc. Or you give it to one more fund, at least 65% of your fund, where they also invest 65% or 90% in that other fund. Then we call it as CIC. You can read that terms later. Or whether your group has more than one CIC. There are 4 conditions that has to be checked under clause 16. Now cash loss. If there is any cash loss in the last year and the current year, then that also has to be checked by the auditor. Resignation of statutory auditor. Whenever you are resigned, the incoming auditor should check. Are there any observation given by the outgoing auditor? That also has to be checked. So resignation of statutory auditors and whether issues raised by outgoing auditors were considered or not. Then 19th one, material uncertainty. You remember that 570 just now we discussed in the one more video. So whenever there is some material uncertainty, that also has to be dealt in 19. So important one is CSR amount. What is CSR unspent amount? In law we discussed section 135. Whenever you are a company, you are supposed to spend at least 2% of average annual profits of last 3 years as CSR amount. But you failed to spend that required amount. Consider you are supposed to spend 5 crores, but you spent only 4 CR. Now the remaining unspent money is related to what? Are you doing any project? Still project is ongoing. That means that 1 crore related to ongoing project, treat it separately. No sir, project is completed, that 1 crore we left it extra. That is left extra. Then you should treat it separately. Now, if it is non-ongoing project, then immediately for schedule 7 account, that is, don't write this as in the examination, schedule 7 bracket IPF account within 6 months of the financial year, end of financial year. If it is ongoing project, then you keep it in a special CSR account. Whenever it is required, you use it. So 6 months is important here within financial year. Then 21 is last section is last clause is what? Wherever you are an auditor of the holding company, then audit is done by, for example, other auditors are already done the audit of subsidiary companies. The other auditors might have given CARO reports. In their CARO report, if one auditor told that CARO report of this company, A subsidiary, B subsidiary, C subsidiary, 1 to 4 clauses is not correct, then you are a holding company CARO, you just tell that in subsidiary A, CARO clause 1, 2, 3 is reported by that company auditor. Again, this company auditor, this is what clause 21 has to be told. This clause 21 is applicable only for group companies, that is holding company. Remaining 20 clauses are applicable for all the, or simple terms, this CARO is not applicable for CFS. Only 21 clause 21 applies for CFS. Other standards, other clauses are applicable for SFS, standalone financial statements. This applicability anyway we discussed. Some exemptions also we discussed. It is not applicable part. This is the entire CARO 2020. 5 marks. There is high probability of testing in the examination. Please take care of that CARO. Don't ignore it. Very important and simple also. There is nothing in this. Whenever we discuss the questions in question bank, you will understand how it is being tested in the examination, right? If you have any doubts, you can ask us. You can comment in the comment box, or you can contact us via our website or mobile number given below. So that's it for the day, guys. If you would like to buy the classes, you can contact the details, contact to the details given below, and see you in the class. Take care. Bye bye.